All right, I guess we can start the workshop. Welcome everybody to the workshop on China in the international financial system, organized by Sebastian Horn at the World Bank, Carmen Reinhardt at Harvard Kennedy School, and myself from the Kiel Institute. We're very much looking forward to 2 days of online discussions. We have a great great series of papers being presented. The theme of the conference, or the workshop, is part of the Research Policy Network by CEPR on international lending and sovereign debt. And the focus of this research policy network is, among others, on emerging trends in international finance. And one of the big trends, of course, in recent years has been the rise of China in the international financial system. Many of you know that there's this very large literature on international capital flows, on global capital allocation, but much of it focuses on the role of the United States or Eurozone, Japan. Much less has been studied on emerging markets, the rise of emerging markets as lenders, as investors abroad. One reason why China's role has been so understudied in recent years is that it's just much harder to get the data, right? To access data that allows for rigorous analysis. But researchers in this workshop have shown that it is indeed possible to do serious work on China's role in the international finance, and much more is needed in the coming years, given the relevance of China. I think this is a literature that is still way too small. We know much less compared to other important phenomena in international finance. I'm very much looking forward to these 2 days and hopefully much follow-up work on the topic. Let me now hand over to Sebastian Horn, who will moderate the first session, and who's in fact also been absolutely central in pushing our own China agenda, but in organizing this workshop. So Sebastian, floor is yours.
Thank you, Christoph. You said, I think, the most important things. Let me just also extend a warm welcome to everyone. We're very excited to have been able to bring together these 8 presentations, very interesting papers as we find. Let me highlight that we called this a workshop for a reason. All of this work is brand new. It's ongoing research, so we really hope this will be at the frontier of research. I really want to encourage all of you to ask questions and to join into the discussions. I don't want to go into much detail on the agenda for today and tomorrow, because you've probably all seen the program, but just as an overview, we have 4 different sessions with 2 papers each. So there's 45 minutes for each paper. We're aiming for 30-minute presentations followed by 15 minutes of Q&A. And as I said, we want to welcome everyone to come in. You are free to ask clarifying questions during the presentations. For that purpose, just raise your hand and we'll unmute you. And you can, of course, also do the same in the Q&A following the paper presentation. So without much further ado, I want to hand over to Saleem Bahaj, who will kick off the first session at the workshop. There's actually a mistake here on that slide. Saleem will present the paper, The Monetary Theory of Exchange Rates Redux, Evidence from China. Saleem, thank you very much for being here and presenting, and the floor is yours.
Excellent. So thank you very much. I'm just full screen my slides. Is that okay? You can see everything correctly? Perfect. So thank you. It's my pleasure to start this workshop, and thanks for the invitation. As Sebastian said, this is very fresh work, and I'm very much looking forward to all of your feedback. So what are we interested in here? So our starting point for this project, I said joint with Ricardo, is on China's dual currency system. So I imagine, as many people in this audience are aware, China has sort of 1 unit of account, the RMB, but it issues 2 currencies: an onshore currency, think about a deposit in a bank in mainland China, which we call CNY, and an offshore currency, think about a deposit in a bank in Hong Kong or outside of mainland China, which we call CNH. And there are capital controls between those 2 currencies, and so their price need not be the same. on these charts that I showed you, the essentially the relative price of these two monies. So on the left-hand chart, I've got the CNY and CNH exchange rate vis-a-vis the dollar, and there are two lines here, but as you can see, those two exchange rates co-move very, very tightly together, and they sort of track the dollar exchange rate. Well, on the right-hand side, I have deviations from parity. So there is variation. There are situations where CNH and CNY are priced differently. Typically, they're in the past few years, they're between sort of plus and minus 100 basis points. And that vastly exceeds the transaction costs of an arbitrage strategy. So there are, this is evidence that capital controls bind in the way. You can't just arbitrage away the pricing difference. And what we're interested in here is, we can see that there are deviations from parity, but they're relatively small. Okay, so how can we think about how this exchange rate is managed? So China's issuing these two different currencies. What can we learn about how the relative prices of currencies are managed, and what's that mean for sort of theories about how exchange rates are determined? And I want to argue that actually this is a great testing ground, because we have one economy essentially issuing two different monies. There's one central bank in a way in charge of the system. We can write down models of how that system should work, and so we can get a much finer picture of how we can manage an exchange rate. And then we also have some good data for this market as well, as Christoph was saying, so we can try and test those predictions in the data. Okay, so I mean, the title of the paper was about the monetary theory of exchange rates. Let me just briefly explain that. I have this quote here. This is a very old theory from Musa in '77, saying the exchange rate is a relative price of two monies, okay, rather than national outputs. And that very much makes sense in this context, in the sense we have one economy issuing essentially two different currencies. Okay, so it does definitely make sense. And it's determined by the exchange rate is determined by the demand and supply of those two different monies that are out there. Okay, so if you think about that theory, you can sort of show that in this simple four equation model that I've written down here. There's a UIP condition linking the nominal exchange rate between one currency and another with the expected exchange rate depreciation, a simple PPP condition defining the real exchange rate, and then two money demand equations, which says that the real money demand depends on the interest rate. If you want to cause your currencies to depreciate, you can print more money. That moves you down the money demand curve to interest rate falls, and via the UIP condition, that causes an exchange rate depreciation. Okay, so that's the idea. The central bank controls money supply and therefore control the exchange rate. If you want to just maintain parity, you want to choose your M, your money supply, in order just to offset the various different shocks that appear in these four equations. This is the foreign money supply, and then shocks to UIP, to PPP, and then money demand that appear here. The trouble is, this theory sounds great, but it really doesn't work very well in the data. Okay, so if I just show you a very quick picture here. So now I've just taken all the data from the IMF's International Financial Statistics database. I've plotted the change in relative money vis-a-vis the US and the change in the exchange rate vis-a-vis the dollar. And you can basically see, almost no relationship between money supply or money stocks and the exchange rate. If you look at just peggers or managed floaters, where you'd expect there to be a much stronger relationship, because they have to try and manage their exchange rate somehow. If you look at the relationship between, say, past appreciations and money growth, again, it's relatively weak. Okay, so you don't actually see a strong pattern. Okay, so the theory is sort of hard to disentangle in the data, and the reason for that is kind of straightforward. If you solve that model I wrote down forward, you get this expression for the exchange rates. It's the expectation of shocks to money demand, to PPP, to the UIP condition, and then money supply. If the other shocks in the system are very, very volatile, and they are, it's very hard to identify an effect of a money supply shock. And then that brings me back to China and CNH and why. What makes it a good testing ground for this theory? Well, first, this is almost in the way one economy or two different currencies has integrated good markets. So we don't expect to see large PPP shocks. So the variance of V should be relatively small. In terms of UIP, we have the same banks operating in both sides of the border, offshore and onshore. And we can sort of model their behavior in both markets. And so hopefully we can either explain UIP shocks or at least have relatively small UIP shocks. The People's Bank of China effectively controls the relative supply of both monies. So it controls M0 and M. Okay, so we're sort of reducing the variance of the M0 shock as well. And lastly, I think most importantly, surprisingly enough in this context, we actually have very good data on the offshore monetary framework. Okay, we can observe things at high frequency that allows us to test some of these ideas. Okay, so what's my plan for the rest of this talk? I guess I have another 25 minutes or so, or 20 minutes or so. First, I want to give you some more institutional background, and then I'm going to show you a simple first test just from the time series data, a monthly frequency, just showing how well there is a fit between relative money and the exchange rate for CNY and CNH since sort of 2017. Okay, that this theory actually works quite well. And then I want to dig a little bit deeper and actually write down a more structured model of the offshore and onshore banking system. So the policies that try and maintain parity between CNY and CNH really transmit through the banking system. That's going to tell me, which M do I look at, which money is relevant, which interest rate should I look at, and I can develop some much clearer empirical predictions, which I can then test in the data we have in terms of how that monetary framework works. Okay, so that's the plan for the talk. So just very briefly, I'll just give some institutional backgrounds. So you can think about a deposit in the mainland as being in CNY, deposits in Hong Kong, for instance, as being in CNH. There are deposits in London or Singapore as well, but Hong Kong is the primary location of a CNH deposit. Both are sort of denominated in RMB, but as I said, they can have different prices. China has a closed capital account. What that means is like the reserve that backs the offshore deposit is not the same as a reserve that backs the onshore deposit. Okay, we can't frictionlessly transfer them around. And this is key because otherwise, for some agents, you can transfer CNH to CNY one-to-one for specific purposes, and I'll come on to that in a second. But without the capital controls, if everyone could do that, we either have parity, so there would be just a one-to-one exchange rate, or one currency will not be held in equilibrium. We just get a version of Gresham's law where the overvalued currency will not be held in equilibrium. So we need these capital controls to sort of actually make this dual currency framework work, which I think is very intuitive. And we all know about Chinese capital controls. We have quotas on CNY, CNH exchanges for investment purposes and also household transfers. Banks can operate in both markets. So they do consider relative returns, but there are restrictions on cross-border interbank lending, which I'll talk about when I get to the model. On the other hand, we have an open current account effectively in China. So Chinese firms can trade using either currency, and there's a process for transferring CNY to CNH and vice versa for the purposes of international trade. And then some firms also accumulate large deposits in both currencies. And then the CNH market itself is a free currency. There are no capital controls, and you can buy and sell USD freely with CNH. And the last point, we can think about the offshore reserves as being issued by an offshore clearing bank. So they're the ones who sort of issue the reserves that back CNH and settle the payments between them. It's slightly more complicated than that, but that's the sort of a first pass for thinking about how monetary policy works, or sort of offshore. Okay, and they act as an agent of the PBOC, and they have a direct connection to the onshore payment system. So you have this idea: the offshore clearing bank issues offshore reserves, which settles CNH transactions, and they are the pathway to the CNY payment system, where the PBOC is then issuing CNY reserves and settling the CNY payments. And that'll be clear a bit later in the model. Okay, so as a first pass, this sort of framework, what I'm showing you here is a time series plot at a monthly frequency of relative money. So this is the log difference in CNH versus CNY site deposits, and the log exchange rate between CNH and CNY. And there's a few things that sort of stand out here. So first, there was a period of reforms to the CNY USD exchange rate that happened from August 2015 and finished in May 2017. And that caused a misalignment in the CNH CNY exchange rate. So there was a long period where actually CNH was trading at a substantial discount. And also the first data point is that, well, we had this substantial discount here. How did the PBOC address it? Well, it intervened and it actually constrained the supply of deposits in CNH in this episode here. It imposed capital controls to do that, and that generated this sharp appreciation in the CNY exchange rate relative to CNH, or CNH appreciated. Okay. Since then, since those reforms have happened, we have a much more stable system. I'll discuss how margin operations work. But we had a sort of a more stable period of money growth in the CNH market, and also a more stable period of the CNH-CNY exchange rate. If you look at that period, you sort of run the regression, okay, is an exchange rate depreciation in the CNH met in the following period by a reduction in the money stock in offshore relative to onshore? That's sort of the prediction from the theory. You get a pretty good fit. So you're getting a coefficient of -12 here. That was a much bigger number than we see if I just run it for all peggers in the economy, also in the world. The R squared is still low, it's around 3%. That's still 10 times greater than the coefficients for my wider sample. And that's all driven by a contraction in CNH. So basically what we're seeing here is that the offshore money supply is being contracted as opposed to the onshore money supply. So we're managing this exchange rate as you would expect by contracting the offshore money supply. Okay, so what's really happening since 2017? Well, we have a quite organized framework now for managing the CNH money supply. So the PBOC actually issues bills denominated in CNH on a regular schedule. So these are liquidity absorbing operations. They're a regular schedule, which is giving a pre-committed period where agents know, okay, we'll be absorbing liquidity in CNH over this time period and this quantity for these maturities. We have 3 month, 6 month, and 1 year bills outstanding. Okay, and what this really is equivalent to is like reverse repo operations happening regularly, just to make sure that the supply of money in CNH is being managed. At the same time, the HKMA has been acting as a CNH lender of last resort. Okay, so they have multiple CNH liquidity facilities. So they're lending out essentially RMB to banks in Hong Kong, and these operate just like a discount window. So there's penalty rates attached to them. If the bank needs to borrow liquidity for emergency reason, they pay that penalty rate. The only difference is that the penalty rate is pegged to an interest rate which is linked to previous interbank market rates. So actually there's a feedback loop from tight interbank market conditions, which actually raises the interest rate on the emergency facility and tightens the interbank market position even more. So there's an extra kick here coming from that penalty rate. And to fund this, it has a pool of its own resources. So it has a deposit of RMB or CNH at the Hong Kong Clearing Bank. And that's basically what funds most of the operation. In the emergency, it can call on a swap line with the PBOC to get extra funding. Okay, and then this post sort of April 2017 era. Okay, so that's sort of looking after this sharp decline here and the end of the CNY reforms. The two central banks have done a much better job at managing the CNH-CNY exchange rate. So what I'm showing here is just sort of parallelogram. Shocks to the exchange rate were much more persistent prior to, well, including in prior to April 2017, than they were post April 17. Okay, so able to absorb shocks much more quickly under this regime. Okay, so to fully understand how this all fits together, so we have these two central banks supporting liquidity and money supply in the offshore market. I want to write down a model of the banking system, and I want to think about what that means for exchange rate determination and how those different monetary policies affect the exchange rate. And this is a very simple stripped down model. Banks are going to operate in both markets. They're going to make onshore and offshore loans. They're going to hold offshore and onshore reserves. They're going to need to fund themselves from the interbank market in both places. They'll raise capital. They'll have deposits in both markets, and they can rely on official borrowing in both markets. And I know there's also the option to hold bills. I'm putting that in grey because that adds a lot of notation to the model, and so I'm not going to show it to you, but that's sort of there in the background. I'll discuss it a bit later. So the environment here is we're going to have, everyone risk neutral, competitive markets, no discounting. There's a single consumption good that we care about, and it'll be a 3-period model with liquidity risk and intermediate period. So in period 0, bank basically pick their balance sheet. In period 1, they suffer shocks to their deposit holdings, and that's going to motivate the holdings of reserves in both different currencies. If they have a deficit, they can borrow from the interbank market or from the central bank to close that deficit, and capital controls will prevent fully interbank lending flows, equalize the interbank rates across the market. In period 2, we will get payoffs, and this model is just to flag it, is really in the spirit of Bianchi-Biggio 2022 and Bianchi-Biggio-Engel 2023. A couple of things to say extra. One is that I'm going to make the numeraire effectively the onshore reserve, okay? And it's the price of an offshore reserve per onshore reserve in period 0. There's E here, which will be an exchange rate. So this is the rate at which banks are happy to hold offshore currency in exchange for onshore currency. At date 2, all assets will pay off in the consumption goods, so the exchange rate will just be 1. So all we think about is this initial exchange rate in period 0. The rest of the economy is completely stripped down because our focus is on the banking system. Okay, so that's what's going to drive the exchange rate determination here, and that's where the policies operate. That's what we're interested in. So banks just have a concave lending technology which converts real goods to real returns, both offshore and onshore, and bank liabilities just be held by deep-pocketed households. The opportunity cost of funds of 1. The only extra feature here I wanted to flag was that deposits will offer a liquidity service to households, and that'll be the liquidity service which is different for offshore versus onshore deposits. So there'll be some liquidity service they get from holding deposit onshore versus offshore, and these U's here will just be sort of the same money demand shocks as you saw in the previous, the first slide essentially. Okay, so period 1 is the interesting period. It's when you have these liquidity shocks, and what I mean by this, I mean that some of the bank's deposits, both offshore and onshore, are used to make payments, and that reshuffles deposits around the banking system, okay? And the bank can end up having a deficit or surplus of liquidity. So this omega J is a random shock that happens because its depositors make payments and move money around, okay? And the liquidity service will be the depositors, the surplus will be the depositors left plus the reserves that the bank has, okay? And there'll be an offshore and onshore liquidity service. And then what we're going to do here is actually have this dual currency and open current account embedded in the model. Okay, we're going to assume that these deposits are shuffled around in a way that, if I make a payment from an offshore bank to an onshore bank for a real economy reason, that can happen freely, okay, and that everything will be allowed to clear at a 1-to-1 exchange rate. And those payments operate in a closed system. So money can flow between offshore and onshore for random reasons. You can't create more deposits in this intermediate period, but I can lose deposits onshore and gain them offshore, and vice versa. Okay. So that leads us to a situation where there'll be some aggregate liquidity surplus available in the offshore market and some aggregate deficit. Okay. So this is a total sum across all banks that have a surplus. This is a sum across all banks that have a deficit. And there'll be some net interbank lending that happens from onshore. And the central bank can control how big W can be. And that leaves us with a measure here of interbank market tightness. And so if the bank has a deficit, it has to go to the interbank market and try and find a borrower. If it can't do that, it has to go to the central bank's lending facility. If it has a surplus, it's to go and try and find someone who it can lend the money to. If it can't do that, it just leaves the money as reserves. And what we're going to assume is the probability of finding a potential match as a borrower falls with market tightness, as a lender it rises with market tightness. Okay, and then we can think about what's the payoff of having a surplus or a deficit in these particular markets. So we'll have interest on reserves being RM, RZ is going to be the central bank liquidity facility rate, and RF would be the interbank rate, which will also be increasing in market tightness. And basically we have these two expressions: the marginal cost of, or the marginal benefit, I should say, of investing surplus liquidity. So imagine I have a liquidity surplus, which is increasing in theta, is just the interbank rate times the probability I find an interbank borrower to match with. And then if I don't find an interbank borrower to match with, I just get the interest on reserves. Okay, the marginal cost of financing a shortfall, taking liquidity as given, is just the probability I find a lender to lend to me times the interbank rate, and then times the probability I have to go to the discount facility rate. Where does that leave us? So we can think about then what's the marginal benefit of having a reserve in terms of offsetting these liquidity risks, and the marginal cost of taking on a deposit for a bank. Okay, and that's given by these two expressions here. So this is the expected liquidity costs for the bank. It's just basically, it boils down to the expected cost of borrowing from the central bank's liquidity facility. So it's the expected probability to go to the liquidity facility times the size of your deficit times the spread on that facility. And the same thing for the onshore market too. And combining these two equations, we get what we call liquidity adjusted UIP conditions. This is the return on holding a onshore reserve. It's just the monetary return minus the marginal benefit that return gives you in reducing, or plus the marginal benefit that return gives you, I should say, in reducing liquidity costs, and the same thing in the onshore market. And then we have a bunch of empirical predictions that emerge from this. So first, think about shocks. So imagine you have a shock to money supply. That will lead to depreciation, because as M goes up, the marginal value of holding a reserve will go down. There's more reserve out there, they're less valuable, so E will rise. The offshore exchange rate will fall. We can think about the money demand as something that reduces deposits, that also makes reserves less valuable. Money demand shock, which lowers the value of, lowers the demand for deposits, I should say. That also makes reserves less valuable, and that causes depreciation of the exchange rate. And we also think about how a central bank can maintain parity in this situation. So imagine there's a shock that causes depreciation of the offshore market. We have to respond by making a reserve more valuable. And there are two isomorphic ways of doing that. We can either reduce M, the size of the quantity of reserves, or we can tighten controls on W. Okay, what does that mean? Well, that means that in response to an increase in the exchange rate depreciation, you have to borrow more from the liquidity facility. So we have more borrowing from the HKMA, and we also need the interbank rates will go up. Okay. One other thing is that basically climate has no impact on near money assets. There'll be no impact on the price of bills. Okay, so let me just quickly jump, because I'm probably a little bit behind on my time. Apologies for that. Let me quickly jump to the empirical results. So I want to show you the first thing first. What does the money supply shock do to the exchange rate? This is the PBOC's issuance of bills in Hong Kong. This is the CNH bills. This is the actual stock outstanding. Okay, so they've been targeting since sort of 2020 an 80 billion stock of bills outstanding. And what they did in two periods was basically change the issuance schedule to move the maturity structure around. Okay, so they were having the same stock of bills, but the maturity structure changed. And what that meant was that there were periods, which I have here, where there were temporary dips in the stocks of the bills outstanding as certain bonds rolled off and certain bonds rolled on. And there were temporary windows where we had fewer bills outstanding, which is expansion in the monetary base in CNH. And those periods are strongly correlated with depreciation in the CNH. You actually have predictable expansions in the monetary base in Hong Kong for CNH. And what you're seeing here is that for those episodes, just with simple event studies, we see a depreciation in the CNH versus the CNY. Okay. The second thing I want to show you is the idea that we can think of exchange rates as shocks to money demand. So what I have here is just looking at the results from the auctions for these bills, and they're showing that these bills are announced sort of 5 days before they're tendered, and then settled 5 days later approximately. And so if you look at the 5 days between the announcement and the tender, if you have a period where the CNH is relatively cheap, everyone wants to get out of the CNH, and we see a much higher subscription rate to the bill. So basically, you have a reduction in money demand and an increase in the demand for bills instead. So there's sort of a reduction in the CNH money demand essentially. So we can think of these shocks as being, these exchanges as capturing money demand shocks. In terms of given these sort of responses to shocks, how we should think about how the central banks are maintaining the parity, it's interesting to look at the HKMA liquidity facilities. This is the use of the HKMA facility. This is very different from a standard discount window. We're constantly seeing drawings almost every day from the HKMA's liquidity facilities in CNH. And what's interesting is how those drawings respond to a period of a weak currency, and it's quite obvious if we just sort of run the regression that a depreciation causes a higher drawing from these facilities, which is perfectly consistent with the model. We expect the PBOC to respond to this by tightening the interbank market. That drives borrowers to use the emergence facility instead, and we see higher drawings from the HKMA's facilities. And what's interesting is that the CNH facilities actually cover multiple different types of banks, and it's not the big guys who draw. It's the banks need to rely on sort of the standard facility. It's called intra repo facility, rather than the primary liquidity providers. They're not being hurt here. They're really targeting sort of more marginal customers in the interbank market in Hong Kong. And my last slide, I'm sorry for running a little bit over, is just showing you what happens to relative interest rates. So this is the saying that, look, in response to a depreciation in the CNH, we need to tighten the interbank market. We see that here very clearly. I'm just using the 1 month interbank market as a proxy for expected interbank rates, but we don't see any response in bill rates. Okay, so it's all concentrated in the interbank market and tightening that market. Okay, so let me just conclude. Hopefully I'm vaguely on time. CNH CNY, I think it's a peculiar market. It's unusual compared to what we're used to in the West, but it's a very useful market too, where we've seen policy steadily maintain parity. Okay, and that makes it a great testing ground given the nature of the economy in question and the way policy implemented for this monetary theory of exchange rates. And what we find is that the empirical predictions for how that theory should work, especially when you put it in a banking model, are really matched. And it does require, though, a careful measurement of what's the right money to look at. So which facility should you focus upon, and the right opportunity cost in terms of the interest rates. Okay, I'll stop there. Thank you very much.
Thank you very much, Saleem. I think you're right on time. We'll open up to questions. As I said earlier, just raise your hand and Mark from CEPR will unmute you so that you can come in. Let me maybe just start myself, Saleem. You motivated the talk by showing the scatter plot on the monetary theory and found very little support, if I understood correctly, in a sample of all currencies. Now, it's not been entirely clear to me whether you're arguing that there's more to the monetary theory that we thought previously that it might hold in other setups, and we can just identify it in China, or whether you are arguing that it only holds for the Chinese market because of the specific institutional setup.
No, what I'm arguing is that China is a situation where the other shocks are this dual currency system, a situation where the other shocks are smaller in variance. Okay, and so what obfuscates the relationship or confounds it is smaller. Okay. Secondly, we also have a measurement advantage in China. Right. This is my point. I can measure all these things very precisely at a high frequency, and that's why testing the theory is a little bit easier. Okay. And we also have, a central bank that sits on both sides of the problem. So all those things benefits and make that. I'm sure. I mean, I kind of buy the theory. It's just that it's very hard to get a clean experiment, and we can find one here.
So there, Chessie has a question.
So really interesting paper. Just trying to understand a bit on kind of China's incentives for the dual currency system at this point. It seems like if they're always going to maintain parity, you actually don't get much from having the two currencies. And so I was kind of curious if you thought of kind of under what states of the world those deviations would be allowed to open up, and kind of in which directions, if that makes sense.
Or shall I respond, or should we want to collect questions? Sebastian. I just respond now.
As you prefer, Saleem.
Yeah, okay,
there's another one by Aitor, but you can also get back directly to
Okay,
Chessie.
I'll go back. So I didn't get into this, and I apologize, but I guess time was limited. I kind of viewed the offshore currency as being the one that allows for transactions to happen freely and easily internationally. So I am a foreigner who wants to be able to make payments easily in RMB. It makes it much more sense to me to hold a CNH deposit than it does to hold a CNY deposit, all the controls around that are associated with that. Rather than, I guess I can see where you're coming from, Jesse, rather than being like some state contingent payoff structure. So I thought more as like a medium of exchange view rather than a store of value view of why that currency exists. I haven't thought through, I guess you have actually, it's kind of a counterpoint, but I haven't thought through the store value point, like whether actually there's another objective regarding, can I use the contingency of that exchange rate to achieve another goal?
Aitor?
Yeah, thanks. Very nice, thought-provoking. So I was left wondering about how, this looks a little like a kind of closed economy way to look at things, right? And then I was thinking like this role that China has as a reserve accumulator, right? Like very large one, also big role in international trade. And like out of lack of knowledge, I really do not know if any of these two currencies can be used indistinctively for trade, right? And then like this brings me to think whether, in a medium run basis, there is scope to think that maybe, like the international reserve policy of People's Bank of China may be also affecting these two currencies. I don't know if this is going on or not, whether the closed economy setting is the right way to think of it.
So just to say, I've worked through the open economy version of this, so I can add the US or the rest of the world as a third country which can interact freely with the offshore market, but can't interact freely with the onshore market. So I have that version of the model. It's just more involved. It doesn't change the sort of basic intuition of how you go about achieving parity. It does change the interpretation of some of the interest rates that you see, because actually the sort of the implicit tax or the implicit capital flow tax emerges from that version of the model, in terms of like what interest rate do you need to see such that foreigners are willing to hold CNH, but they can't invest in CNY. That generates some, if they can't invest in CNY, that generates an effective wedge in the return, and then you can back out a tax that emerges from this model. Yeah, I just don't think that's sort of a different question. And maybe somewhere we go in the end. But in terms of how you manage the parity condition, the third country wasn't particularly helpful.
Thanks, understood.
Saleem, I was curious about the role of the capital controls. In the model, if I understood correctly, they could be used just like the monetary supply to defend the peg.
Yeah.
Is there actually evidence that China is using controls at this level of frequency to steer the currency. I would have thought of them as a more long-term structural tool to manage financial liberalization.
So let me, again, this is a time constraint thing. So the way it works, so the interbank capital controls are actually quite specific. So the only agent who can borrow from the interbank market onshore and lend offshore is the clearing bank. So that clearing bank is an agent of the PBOC. So they essentially can choose W, right? They can choose how big that flow is. And that to me is kind of like a capital control, but via monetary decision as opposed to a quantity constraint or a quota or something like this, or a tax for that matter. How they choose W is totally opaque. So there's an equivalence between these two things, changing the money supply and changing the flow. All I know is that no matter what they do, I should see what I call Z, the drawings from the HKMA go up. And that's exactly what we see. So one of the two things are happening. Unfortunately, because the clearing bank the HKMA is great, it tells us everything. The clearing bank is not part of the HKMA, and so I can't see what they're doing. Let's see.
Unless there are any other questions also from the general audience, I suggest we move on. We're perfectly in time. Thank you so much, Saleem. And I'll hand over to Jesse for the second presentation of this session called China and International Tax Havens.
So thanks so much for the opportunity to present here. This RPN is just a fantastic idea, and so it's really great to be part of this. This is joint work with Chris Clayton, Antonio Coppola, Amanda Dos Santos, and Matteo Maggiore. And let me start by actually just kind of setting up the the challenge of measurement that we're trying to understand. So in recent years, China has dramatically liberalized its bond market and is allowing in increasing amounts of foreign capital. So I, as an American, can increasingly actually go out and buy bonds issued both by the Chinese sovereign and by Chinese firms. And so here I kind of listed a hypothetical flow to bonds issued by the State Grid Corporation of China. State Grid is the absolutely massive public utility of China. When you actually go into the kind of holdings data, where we have is mutual funds and insurance, what you actually see, though, is despite the fact that State Grid raises huge amounts of capital in China, you effectively see no flows, directly in the bond market from Americans to State Grid. That's not to say, however, that State Grid doesn't raise huge amounts of money from Americans. It's simply that the way in which they do so is by essentially opening up a subsidiary and a tax haven. State Grid oversees investment in the British Virgin Islands. This shell company does nothing but issue bonds targeted to foreign investors. And what we see here is in the data, Americans, Europeans, and other developed world investors are going to buy large quantities of this debt. Now, importantly, when we want to understand how much do foreigners actually invest in China, for the purposes of residency-based international financial statistics, so official statistics, the flow from, if I as an American buy a bond issued by State Grid Overseas Investment, this is going to be recorded as an American lending to the British Virgin Islands. Because this is nothing but a shell company, for all intents and purposes, I want to think of this as Americans lending to China. And so what we're going to do in this paper is essentially quantify just how much how much revenue or how much bond issuance and equity issuance Chinese firms are actually doing in tax havens, and the answer is going to be an enormous amount. And so just to step back for a second, more generally, tax havens are playing an increasing and large role in intermediating international capital flows. So for instance, tax havens are going to account for more than 10% of all cross-border portfolio positions. 14% of all US portfolio investments alone are recorded as going to the Cayman Islands. Tax havens are going to account for around 10% of all corporate financing and half of all cross-border issuances. And for some emerging markets, and China is going to be a great example of this, nearly all of the corporate sector's bond finance is going to flow through these tax havens with a rapid rise since 2005. And so, in this paper, the main thing we really want to take a look at is just how much tax haven intermediated flows are going to Chinese entities. And so how much kind of standard financial statistics are going to understate the exposure of foreign investors to China. And so what we're going to argue is essentially understanding China's role in tax havens is really going to change the map of global capital allocation. So kind of the most prominent example, this is actually from a previous paper with Antonio Coppola, Matteo Maggiore, and Brent Nyman that I'm going to go over as well. The biggest single change in positions through tax havens is going through essentially the Chinese VIEs, that US holdings of Chinese securities are going to be underestimated by around $600 billion. Essentially, this is mostly going to be large Chinese technology companies operating a corporate structure that I'll go in through details in the Cayman Islands that leads to a massive underestimate of how much foreigners actually own of Chinese equities. What I'm going to highlight a lot today is actually something that we, and I think, well, we certainly understand less, I won't speak for kind of the rest of the field, is the extent to which Chinese firms are actually going to raise huge amounts of debt finance in the British Virgin Islands and the Caymans. Now, in the Cayman Islands, it's going to be a lot of the firms that also have kind of their equity shell parent there, like Alibaba and Tencent, that I think is kind of easier to understand. For the British Virgin Islands and the state grid example, I must admit I'm gonna report the findings, but I actually don't think we have a great understanding of what these firms are doing. The state grid is obviously going to be wholly owned by the Chinese government. The incentives to raise money through tax havens is actually not clear. I'm going to talk through a little bit of that, but I do think that's an open research question. The thing I am going to highlight more is that foreign portfolio investment in China is going to disproportionately go through tax havens, and there's a sense in which these flows are actually exposed to uncertain regulation and political risk for reasons that I'll get into. So, in terms of the related literature, generally, the approach we're taking in terms of looking at China's role in tax havens is really building on this kind of nationality-based statistics of, in my initial graph, the fundamental problem is that if I buy a bond issued by a shell company in the British Virgin Islands, we record that flow according to the immediate location of the issuer, the British Virgin Islands, rather than the parent, China. And so there's kind of a lot of really promising and complementary efforts to build these kind of nationality-based statistics. And of course, with the subject of today, we view this approach as kind of a growing literature trying to understand China's role in the international financial system. So with that, let me give you a sense of, I'll kind of go through how we get these numbers, but let me give you a sense of the scale of China's role in tax havens. And so let me begin with the graph on the left for equities. This is plotting over time how much, what share of all equity issuance in tax havens that actually has a Chinese parent. And so by the end of 2020, what you can see is around 55% of all of the tax haven based equity issuance is actually representing a flow to a Chinese company. Predominantly, this is going to be going through the Cayman Islands, but the scale of this is absolutely massive. And so what you can see at the end of 2020, this would actually represent $2.4 trillion of cross-border investment that's recorded as going to tax havens that actually represents a claim on Chinese companies. I think something that we were, I must admit, we were quite surprised to learn was actually the extent to which this pattern has been mirrored in corporate bond issuance. And so what you can see is now for corporate bond issuance by 2019, nearly 20% of all outstanding corporate bonds issued in tax havens were actually done so by Chinese firms. And at the end of 2019, that represented around $600 billion of issuance that would be recorded in official statistics as flowing to these tax havens instead of actually going to China. And so these graphs really kind of open up a few questions that I'm not going to go into, but I want to give you a sense of why they'd matter, because we're using the term of why issue in tax havens. But I think what we are learning increasingly, particularly with China, is the reasons to issue in these tax havens might not actually be about taxes. And so for a lot of issuers, avoiding taxation, corporate, and investor tax, both for firms and investors, may be an important motive. When it's a Chinese public utility that is issuing in the British Virgin Islands, the incentives to effectively avoid taxes feel very different. And so I think that is something we're just kind of wrestling with. The second reason to do so, avoiding capital controls for equity issuance, is what we're really going to highlight is what's going on for China. That effectively, for many industries, the Chinese government will have restrictions on how much of a firm, or if any, foreigners can actually own. And effectively, by adopting these structures in the Cayman Islands, what these firms are going to be able to do is tell American and European regulators, you own an equity claim on our firms, while at the same time turning around and telling Chinese regulators that they're 100% owned by Chinese residents. The third reason to avoid regulation is something that I'll come back to a bit. This is something that we don't have any kind of smoking gun on, but it does look like maybe important for some of the reasons that Chinese firms are issuing. So as an example, in the state grid case that I outlined, none of the major rating agencies will give any credit rating whatsoever to any of the Chinese bonds issued with inside China. They will give credit ratings to all of the bonds issued by this, through this offshore vehicle, even though the assets and the offshore vehicle is nothing, the value of it is nothing but the fact that it is guaranteed by the parent. But there's a meaningful sense in which, for some types of investors, maybe these ratings matter. The fourth reason could be effectively accessing a different investor base. Investors might prefer to put their money into these tax havens versus putting it onshore in China. And so more generally, when I said that we connected to this idea of residency-based versus nationality-based statistics, residency is going to be ascribing the location of investment to the immediate location of issuance. So the British Virgin Islands, in my example, versus nationality, the location of the parent and where control actually takes place, which in this case would be China. Now, overwhelmingly, residency and nationality are going to be the same thing. It's not the case that any international debt issuance is going to have residency not be the same as nationality. So if the Brazilian sovereign issues a bond in New York, that's still going to be Brazil residency and nationality. You effectively need a subsidiary for these to differ. Now, it's not always obvious that nationality should be preferred to residency. So for instance, if a firm has an operating subsidiary that does production abroad, so Toyota Motors North America would be the example. If Toyota Motors North America is issuing bonds in the United States to fund its American production, it's not clear whether you want to call that Japanese because the parent is Toyota, or American because of the location of issuance. Now, where we're most comfortable saying that nationality should be preferred to residency is when effectively it's a tax haven based shell. So in the case of Alibaba issuing, being based in the Cayman Islands, or the example of State Grid having this subsidiary, there's no meaningful sense in which State Grid does any business in the British Virgin Islands. And so how are we actually going to do this restatement? So we're going to follow the approach of our 2021 QJA paper. We're effectively, for ownership, the first step in actually mapping these securities is basically to say, whereas every single security issued in the world on a residency basis, where is that actually, where does that belong on a nationality basis? And so here we'll just combine data from 7 different sources in order to map 27 million securities from issuer to residency. In terms of knowing who actually owns this stuff, we're going to begin with microdata from Morningstar on mutual fund and ETF positions. We're also going to use insurance company holdings and data from the Norwegian sovereign wealth funds. And effectively, we're going to say, okay, this is what every single investment fund owns in every country on a residency basis. This is what it actually belongs to on a nationality basis. In order to restate national statistics, what we're going to do is for every single year asset class bilateral country pair, we're basically going to assume that within each year asset class bilateral country pair, fund holdings are going to be representative of the universe of portfolio investment. I should say we're actually, in ongoing work, we're actually using the administrative data of the European Central Bank to actually not make this assumption. And so we've actually reported investment in China using the administrative data of Europe. But basically, we showed that this is a very good assumption. I'm happy to discuss more. So What this approach gives you is essentially an answer to the question of what share of investments in each country on a residency basis go to every other country on a nationality basis. And so let me actually show you, this is the example for the reallocation matrix for US corporate bonds in 2017. So let's zoom in on the Cayman Islands. So here, what this is saying is that only 1.4% of corporate bonds that are issued, that Americans own in the Cayman Islands on a residency basis, we ascribe to being Cayman nationality. Because the Cayman Islands effectively has no real activity, we view this, the truth is actually zero. And so we view this as we're able to get 98.6% of the money out of the Caymans. Instead, 33% of all American investment in corporate bonds in the Caymans on a residency basis actually belongs in China. And so what this is going to allow us to do, we'll do this for every single country, asset class, and year, is going to allow us to effectively say, well, how much of what's actually being recorded as invested in tax havens around the world is going to China. And so here we can put this together for a range of countries and ask, for equities, how exactly do foreigners invest in China? And so what you can see here is of in this example, it's the $1.8 trillion that we observe. Only this upper gray bar is actually going to represent direct equity claims on China. So think of publicly listed firms in China where foreigners actually go out and buy the underlying security. The lion's share is instead actually going to be intermediated through tax havens. So not only is the amount of money going to China through tax havens large, as a share of all foreign investment in China, the bulk of it is actually going through tax havens. And so this isn't kind of a sideshow. This is the main way in which foreigners are actually doing portfolio investment inside of China. For bonds, what you can see is it's not only the Caymans. You can see, a lot of the money is flowing through the Caymans, British Virgin Islands, Bermuda, and obviously Hong Kong. Here, what we see is a very recent rise, a sharp uptake in direct investment in Chinese bonds. But this is actually drawing on a graph from a paper with Chris Clayton and Amanda Dos Santos and Matteo Maggiore, Internationalizing Like China. All of that, nearly all of that foreign investment directly into the Chinese bond market is actually going to the Chinese sovereign bonds. Kind of coming back to that state grid example, what we never really see is foreign investors directly buying corporate bonds issued inside of China in renminbi. You simply don't see that. And so while here we actually see that an increasing amount of foreign investment in Chinese bonds is actually direct, that's essentially all foreign investment in Chinese sovereign bonds with effectively no direct investment in Chinese corporate bonds. It's, for corporate lending, it's effectively all intermediated through tax havens. Now, putting that together, we can actually see that this is going to be the currency composition of foreign holdings of Chinese bonds. Just going back to 2014, you'd see, around 80% of foreign investment in China is in US dollars, and you would actually see a very small share in CNY here in green. As of 2020, what you see is that 40% of foreigners' bond holdings in China are actually denominated in CNY, with effectively a disappearance of CNH for direct holdings. Building on Saleem's very nice paper. But effectively, what you can see here is this switch in this change in the aggregate currency composition of how foreigners lend to China is all going to be driven by inflows into government bonds, with effectively all foreign investment in the corporate bond market still in foreign currency, because I should have said nearly all of the issuance by Chinese firms in tax havens is going to be in dollars and other foreign currencies. Now, when we put this all together, I want to give you a sense of just how much in equity markets standard residency-based statistics are going to underestimate the degree of exposure of foreign investors to China. And so in red, this is going to be the share of Australia, Canada, Switzerland, Denmark, the Euro area, Great Britain, Norway, Sweden, and the US investment in China. And so let's start with the US. In 2017, the official data of the United States would say that only 2% of American foreign equity investment is going to China. These adjustments we make when we account for the fact that a lot of the investment in the Caymans is actually going to China is enough to move from 2% all the way to 10%. And so this is going to dramatically change the extent to which we'd say the US and China are financially connected. And so in the last part of the talk, what I want to do is effectively turn to kind of a deep dive into the implications of this and giving you a sense of which firms these are. So if you zoom in here, you can actually just look at what are the largest equity reallocations to China. And so let's ignore the ones in Hong Kong. I think these are more standard. You know, we have a lot of reasons why China Mobile would be based in Hong Kong. If you look at the Cayman Island-based firms, what you can see is Tencent, Alibaba, Baidu, NetEase, JD.com. All of these are going to be internet. And of course, internet telecommunications is one of the industries that's declared effectively, forbidden for foreigners to take equity stakes in firms. The other ones, if you actually look, the Tall Ed Group and New Oriental Education, these are actually the for-profit tutoring companies that she cracked down on. So foreigners are not allowed to own a stake in Chinese education firms. You can actually see that these are firms that are also using these these Cayman-based shell companies. So what exactly is going on here? So in a standard equity investment, think of me as a foreign shareholder sitting in New York. Suppose that I want to buy a share of Bank of China trading on the Shanghai exchange. Well, I'll simply buy, an equity share, and this will be, an equity claim of myself on, the Bank of China. However, it's this direct connection that is simply not allowed for firms in sensitive industries. And so what these firms do, Alibaba and Tencent, is they adopt something called a VIE structure, a variable interest entity structure. So the real company, the real Alibaba, the real Tencent is sitting here inside of China. We'll call them the operating company. Alibaba, of course, trades on the New York Stock Exchange. So Alibaba Group Holdings. But that traded on the New York Stock Exchange is not the real operating company. It is instead the listed company, Alibaba Group Holdings, Cayman Islands. And so I will buy on the New York Stock Exchange, BABA, a share of Alibaba Group Holdings. Now, what are the assets of Alibaba Group Holdings? They'll own a few special purpose vehicles offshore, but we can mostly ignore that. The key asset will effectively be a WOFE, a wholly foreign-owned enterprise inside of China. Now, the key is this is going to be an entity inside of China that is not in a forbidden industry. So generally, these are going to be consulting firms. And so the shell company, Alibaba Group Holdings, will own a consulting firm within China. And what this company will do is effectively try to replicate equity ownership without taking equity stake. And so how can you do that? Well, equity, ownership means two things. You have a claim on the profits and you have control rights. And so they achieve that with a series of bilateral contracts. They'll make a zero interest loan to the owners of the firm. In exchange, they'll get power of attorney and exclusive provider services. So they have the right to run the firm. Now that's going to be control. How do you get a claim on the profits? Well, a shell company, this WOFE, will sell consulting services. Think web design and human resource services. And in exchange for those consulting services, the $500 billion company will give them the full pre-tax profits as a payment for these consulting services. And so now this is going to allow Alibaba and Tencent to tell the Chinese government, I have no foreign ownership. Whereas under US accounting laws, what this VIE structure does is it allows the listed company, Alibaba Group Holding, to report on a consolidated basis. So at the same time, the listed company, Alibaba New York Stock Exchange, can tell the American government, well, you're owned by American investors, while the operating company, the real Alibaba, tells the Chinese government, we have no foreign shareholders. And so, the shaky exposure to VIEs is much larger than we thought. And what's interesting about this, to be clear, we didn't discover this. Alibaba puts this in writing in their prospectus that this is a risky structure. So they write, if the Chinese government deems that the contractual obligations in relation to our variable interest entities do not comply with Chinese government restrictions on foreign investment, or if these regulations or the interpretation of existing regulations changes in the future, we can be subject to penalties or be forced to relinquish our interest in those operations. And what's remarkable about this, relinquish our interest in these operations, this is the Cayman Island shell company that's on the New York Stock Exchange saying this. They have no other operations. And so, effectively, we've quantified this, but this was simply put in writing by the firms that went public. Now, Why does this actually matter for our understanding of international macro? So very quickly, a country's net foreign asset position is going to be designed to capture claims on the rest of the world. So it's foreign assets minus foreign liabilities. Now, the change in a country's net foreign asset position over time is the current account balance plus any valuation changes. And what we're going to argue is that the VIE structure is going to dramatically underestimate estimates of China's external liabilities because it's effectively going to be missing valuation changes. And let me show you why. In my example here, if I make a portfolio equity investment in Bank of China, then that's a portfolio equity asset of the United States. How do Chinese statisticians revalue their liabilities? Well, if the stock price of Bank of China goes up, they know that they owe American investors more. It's basically mechanical. How about here for the VIE structure? Well, now it's not me as a foreign investor making an equity investment. The flow into China is the listed company owning a WOFE. And so that's a foreign direct investment into a shell consulting firm. There's nothing that mechanically links together changes in the value of Alibaba and the New York Stock Exchange and what Chinese statisticians will record as the liabilities of China. And so what we can show is that effectively there's this, in red, there's this, huge increase in VIE market value. FDI from Hong Kong, the British Virgin Islands, and the Caymans into China is basically flat during this time. And so, effectively, there's no evidence at all that these valuation valuation effects are actually being marked by Chinese statisticians. And so when we put this all together, this is actually going to have a large effect on our understanding of China's net foreign asset position, how much the rest of the world owes China. So the official statistics up through 2018 is that the rest of the world owes China on a net basis 15% of China's GDP. But when you effectively do the adjustment for the missing valuation effects, you can see that China's NFA should be written down by around $1.1 trillion. Intuitively, what does this mean? Alibaba, Tencent, Baidu, these are some of the most valuable Chinese publicly traded companies. They were sold to foreigners. There was a huge run-up in their market value, and these valuation effects simply weren't recorded. So this would have a large effect on our understanding of how much China owes the rest of the world. Now, the final thing I want to show is basically in the time series. There's a few other ways in which, this paper has really been about going from a residency-based statistics to a nationality-based statistics. And here for the US, this is, plotting the time series version of the bar chart I showed you. You can see that in blue, on a residency basis, the amount, the share of US external investment that goes to China has been roughly stable at around 2%. With the rise of these VIEs, you can see on a nationality basis, we've seen this go up, significantly above 10% by 2020. Now, still though, this is still fundamentally only allocating, one firm to one country. And so one of the things we've done that we're excited about, and I should say all of this data is online, is instead of ascribing any firm in the world to one country based on its headquarters, we've taken the geographic revenue distribution of firms, so where firms in the world actually earn their revenue. And instead of assigning a firm to a given country, we've asked, well, let's say you own an equity, thinking of, kind of exposure to demand shocks. Where do these firms that you own equity in actually earn their revenue? And so we can take the universe of portfolio holdings, assign firms according to the geography of where they earn their revenues, and then instead say, well, how much more exposed is the US to China? And so, of course, what we can see here is this is going to go up to around 20% of American equity ownership is actually going to be, on a demand basis, actually going to be exposed to China. What's remarkable, though, is actually how much of the work, even now, the VIE adjustment is doing. And the reason is Tencent and Alibaba and the other firms with VIEs earn an overwhelming share of their revenue inside of China. So effectively here, the sales-based and nationality are going to be doing the exact same thing for China. And so I just want to conclude here, kind of methodologically, what we've really focused on is kind of piercing the veil of these tax havens to restate bilateral investment. We've shown that China is a particularly important destination of tax haven intermediated flows. And so while these equity flows are VIE driven, there's a lot more uncertainty on the motives for bond finance. I think that's a kind of a particularly promising direction for future research. And just to plug here, we tried to put absolutely everything and way more that I've shown you today online, code data at globalcapitalallocation.com. And so please use the data, and always feel free to reach out if you are trying to use the data. So thanks so much.
Thank you very much, Jesse. Really fascinating and mind-blowing to see how these laws are being structured there. We'll open it up. Just raise your hands, and we're happy to unmute you. Christoph, please go ahead.
Yeah, great stuff. Well, you know, I'm a huge fan. It keeps getting better. So I have a question on, you know, you showed the legal structure. Two questions. Why is China tolerating this? And could they just basically expropriate all of this money with yeah
Okay,
with the decision?
So why they're tolerating it, I'm going to say here, if there's speculating on Chinese political motives, I'm terrible at, and so big uncertainty here. I do think that there's been evidence that they do exert more control with this VIE structure than other forms. So a great example would be Ant Financial. Before, you know, so we've been following all the ups and downs of the payment system trying to go public. But before it was Ant Financial, and at one point it was, people thought it would be valued for $500 billion. It was Alipay, a subsidiary of Alibaba. Okay, and effectively, initially, there's actually a case by my former colleague Wei Jiang that goes into this in detail. The Chinese government effectively told Alibaba, with this VIE structure and foreign ownership, you can't control the payment system with Alipay like this. Okay. At this point, they had already had a huge equity investment from Yahoo. But what Jack Ma effectively did is spin off Alipay, effectively walk away with an asset, in the way in which the Chinese government wanted him to. And foreign investors effectively do not want to challenge that opposition in Chinese courts, because the overwhelming fear that investors have is that the entire structure is going to be challenged. And so there's a sense in which the fact that foreign, it is, I do think, meaningfully limiting the ability of foreigners to do this. That said, the government seems like it's cracked down on these structures pretty significantly. I don't actually think if they wanted to harm foreign investors, what they would have to do is expropriate. There are much more subtle ways that honestly seem pretty justifiable. In that example I gave of, paying the full pre-tax profits of the company to the woofie for consulting services, if you recognize that that was exactly what it is, a dividend, and you tax it, like dividends, all of a sudden the value to foreign investors goes down massively. And so they seem to have displayed a large unwillingness to, actually expropriate. I think that it's but there's been a major effort to effectively not allow firms to do this going forward. And you've also seen the US government, there's laws in Congress that are effectively, bills in Congress that are looking to crack down on this. On the debt side, to me, that's the most interesting. Sorry, not the most interesting, but it's there. I think you could see the incentives of the Chinese government and the firms much more aligned. Effectively, the use of these tax havens is a way in which, with very little oversight and disclosure requirements, the major state-owned enterprises are able to tap international capital markets. You don't have the rating agencies getting access to the full books of the underlying SOEs. Instead, they're just giving solid investment grade ratings to the shell companies, which just gives many of these state-owned enterprises a way to raise money offshore. And so we, CNOOC, Sinopec, and State Grid are all big users of these tax havens. I personally would be surprised if the Chinese government allowed, if it was the SOEs avoiding taxes, that seems harder to understand. If it's a way to avoid oversight of foreign investors, it seems like the incentives of the firms and the government are more aligned.
There's one question in the chat, Jesse. I'm not sure you can see it, otherwise I'll just read it out, by Martin Kessler, saying, very impressive findings on your NFA overestimate point. Shouldn't we see the payments for services, the $1 trillion USD in HR services consulting to Cayman Islands, show up in the current accounts?
Great. Okay, that's a great point. So here, so let me be clear here. the payment for the consulting services doesn't actually have to take place. It doesn't have to go offshore. That's a within China adjustment. Effectively, that WFOE is within China. The payment to the Caymans would be a dividend payment. And so the payment for consulting services to the WFOE, that stays inside of China. When the money leaves China, it would have to be as dividends. And one of the things that's really remarkable about these VIEs is that most of them do not pay dividends. And what is very hard, sitting where I am as an academic, to figure out is, are they not paying dividends because they think that they are growth firms? Or are they not paying dividends because it's the act of paying dividends that exposes all of these flows to tax risk and makes it more salient? But what you actually see, and you can see investors talk about this, it's not clear why they're not paying dividends, but that is when you would see it in these statistics. And because these dividend payments are so small, you do not see large flows from China to the Caymans. It's a great question, though.
And then Chang has raised his hand.
Hi, Jesse. Very, very interesting work. I was curious about the corporate bond rise since 2010. I was wondering whether that's going to be related to the full trading stimulus plan in China, and also I wonder which companies are issuing corporate bond to the foreigners. Are they state-owned enterprises or POE, or alternatively, how much of the I'm not sure whether your corporate bond include those local government bonds. I was wondering whether you can comment on that.
A great question. Okay, so I could be wrong here. I don't believe we saw local governments issuing in tax havens, but I'll check and let you know if I do. For corporate bond issuance, it's across the board. So you see, I flagged the SOEs mainly because I was so surprised to see the SOEs. I was not expecting them there, but you saw Evergrande was a big issuer. You saw a lot of the real estate companies issuing. Effectively, most of when people talk about international issuance of Chinese corporate bonds in dollars, most of those are actually in tax havens. And so any of the investment in dollar-denominated corporate bonds of China are actually in tax havens. And so it's the large companies across the board that are doing it. If you see dollar bonds, they're generally in tax havens and not in China.
Okay, thanks.
There are two more in the chat.
Yes. Okay. So first, Alibaba listed in Hong Kong, the holding structure there. So Alibaba actually has a Cayman Island-based parent. So Alibaba listed in Hong Kong. That's a cross listing. The parent, you still have the shell company in the Cayman Islands in the exact same way that listing on the New York Stock Exchange. Listing on the New York Stock Exchange is actually an ADR where the underlying equity is a claim on the Caymans. I believe you have the exact same issuance in Hong Kong. You don't actually have the underlying Chinese firm issuing in Hong Kong. It's still that parent. Tencent is primarily listed in Hong Kong, but they also have the Cayman Island-based VIE holding structure. It seems that the VIE structure from Nadim Aftab seems that the VIE structure through some sort of indirect CF corporate finance and control rights imposes additional risk. Is there any way to capture the risk premium from investors' perspective? We have been thinking about this for a while, and the answer is I don't have a great idea. So let me tell you what doesn't quite work. We had thought for Alibaba, what we would do is do something like deviations from ADR parity. So usually when a company has an ADR, you have the underlying and then the version trading in New York. And so for instance, when Argentina has capital controls, you can construct a black market exchange rate by comparing the price of, let's say, YPF in Buenos Aires and YPF in New York. And you have this very nice measure of a discount and the frictions to getting money in and out of Argentina. The fundamental challenge with doing this for the VIEs is that the underlying equity is not publicly traded. And so effectively, there is no Alibaba that trades on the Shanghai exchange without political risk. And so I apologize, I forgot the citation. There's a nice paper that effectively tries to do it on observables that, basically try to find a control group of firms that trade in Shanghai, but you can't do the underlying and ADR comparison. You have to hope that you have two firms. And so it's effectively a multivariate regression controlling for observables. That's what you'd have to do. But the challenge, of course, is the firms that select into the VAE structure are going to be different. And so it's been on something we'd wanted to do forever, and we haven't done it because we haven't had a great way to do it.
Jesse, can I ask you about the other way around? You're focusing on inflows to China. What about the outflows from China to the rest of the world? When looking at lending and investment data from China to developing countries, for example, it seems to me that an increasing share is being extended by foreign subsidiaries that are also based in tax haven companies. Could similar mechanisms be at play here? I presume the incentives probably differ, right? But could we also be underestimating Chinese claims on, say, emerging markets?
Yes, and I think that would be, but I don't have any estimate for it. For instance, I mean, actually related to your work, if the Chinese Development Bank has a subsidiary that is based in the Caymans that is lending to countries, we would have no idea how to see that, but that would represent a Chinese claim. I don't know how, for FDI and bank lending, I don't know how to solve that problem, and I don't have a sense of how big it is. But there's, generally, there's a very nice paper by Niels Johansson and co-authors on they call phantom FDI, which is effectively the amount of FDI that's going through tax havens. There's plenty of reasons to think that this problem is just as large there. I don't know if China has the same disproportionate role in FDI and bank lending in tax havens that it does in portfolio investments, to be honest.
Do you see CDB and XIM? Sorry, so skip the queue. Do you see CDB and XIM raising money via tax havens, issuing bonds?
Let me look into that for you, because I know I'd be very curious. I don't know.
Me too.
It's actually instant to check. I'll shoot you an email.
Are there any other questions? If not, thank you very much, Jesse. That was super interesting. And I suggest we go on a small, roughly 30-minute break and then resume with the second part of the day and two very interesting papers by Chang and Andreas Presbitero. Thank you very much.
Thanks so much.
In Shanghai, China. So this paper is a joint work with Alexandra Ribucci from Johns Hopkins and C.D. Zhou from University of Macau. In this paper, we study China's increasing global financial impact. Now, as we know, China is a large economy and can affect the global markets through many ways. There is a lot of evidence documenting Chinese financial and the real channel to the rest of the world. The real channel include the trade channel, FDI channel, and commodity demand channel. And the financial channel include official flows. This is gonna be the flows from the public sector. In this paper, we also look at the financial channel of Chinese investors, but differently, we focus on Chinese private sectors. In other words, we ask whether Chinese private portfolio flows can generate a price impact on world stock markets. We believe this question is important because as China fully liberalizes its financial market, there will be sizable outflows from China to the rest of the world. And most of these flows can come from the private sector. As it's known to all, China has large savings trapped domestically, and private households would like to invest worldwide for diversification purposes. Given this question in mind, we want to understand at the current stage, given China imposed a large capital controls policy, whether the size of private portfolio flows is large enough to generate some price impact on the world stock market. As I will show you later, the size of portfolio flows actually is non-negligible, and our answer is yes, there will be some price impact on the world stock market. How do we tackle this question? Well, we're going to combine two sources of data set to answer this question. First one is we're going to combine or utilize the macro level data on individual stock holdings of one specific Chinese private investor category that is called QD mutual fund, Qualified Domestic Institutional Investor Program. That was a special scheme under current capital controls policy for domestic households can easily access to overseas stocks. For example, myself actually access to US stocks mainly through the QD mutual funds. And we can argue that this QD mutual fund is representative for all Chinese private investors, and we use it because they disclose detailed stock holding information by regulation, and we can use it for identification purposes. This is the first set of data set that we're going to utilize. And to achieve identification, we also need to have some China-specific shock that ideally only affect Chinese private investors, and through their trading behaviors affect the stocks they held. For that purposes, we use two sources of China-specific shocks. One is the Chinese monetary policy shocks identified by previous work, Chen, Ren, and Zha 2018 AER paper. This is a quarterly series shocks to Chinese M2 growth rate. The second type of shock we use is early phase of COVID-19. Arguably, COVID-19 first hit China in January 2020. And back to that point of time, one can argue it only affects Chinese private investors' behavior and later spread out to the rest of the world. Using these two types of shocks, we can see how Chinese private investors respond to this shock and how their trading behaviors affect the world stock markets. And by doing so, we were able to say something about the price impact. That's essentially what we do in this paper. Now, before I jump into the details, I would like to provide some status facts on the Chinese foreign portfolio equity assets, that is a private sector holding of foreign stocks. Now, if you look at the Chinese external assets, you get the impression that the lion's share of those assets is still held in the public sector. That's a reserve assets, followed by FDI and other investments. The red line here is our focus, which is a portfolio equity investment by the private sector. If you look at this time series, it's very interesting. It was very small in 2004, roughly speaking, $0.0002 trillion, but it has been growing up to a level that is non-negligible. In 2021, the number is $0.648 trillion. So that's roughly $650 billion. This number is non-trivial. It's comparable to South Korean and Australians investment worldwide. It's about a third of the UK, Japanese foreign investment in equity market. So these dramatic increases in foreign portfolio equity assets is consistent with the policymakers' efforts to continuously liberalize their outflow restrictions. Now, this effort can be also seen in the widening of the QD held stock global footprint. For example, you can look at the number of QD funds set up by private sector to satisfy domestic household investment need overseas. The number of QD funds was roughly 10 when it was started in 2007, but reached to a number close to 150 in 2021. The number of firms held by those funds was roughly a few hundred in 2007, but reached a number over 3,000 in 2021. Clearly, Chinese government make efforts to liberalize these outflow restrictions to satisfy the growing diversification needs of domestic households. Chinese private investors also have global coverage. If you look at the number of firms listed in different markets, United States actually ranked number 1, and followed by Chinese Asia's market, Hong Kong, Taiwan, Japan, and so on and so forth. So they have a very wide range of geographic distribution into the country. Moreover, they also have a wide variation in terms of industry. The private investors would like to hold stocks in pharmaceutical products, electronic equipment. They don't like stocks in defense and fabricated products. Now, given this macro status fact, you get the impression the size of portfolio flows from Chinese private investors is growing, and it also have a global footprint everywhere. Now, the question now is whether such an investment size can generate some price impact on the world stock market. Our answer is yes. And we answer these questions through two ways, using two China-specific shocks. One is Chinese monetary policy shock, and the other is working in progress, which is early onset of COVID-19. Now, in terms of a Chinese monetary policy shock, we use it as conduit to trigger Chinese private investors trade. Our first empirical finding on this one is about a macro correlation between Chinese monetary policy shock and MSCI country stock returns. We find there's a strong positive correlation in the data, and this macro correlation holds conditional on other global shocks. For example, like US monetary policy shock and global VIX indexes. And we noticed that there is a channel through which monetary policy could affect the rest of the world through the real economy. That's why when we document this macro correlation, we carefully control for the real economic channel. We control for country level fundamentals. We also control for the real economic linkage between this country and China through trade. After we do all these things, the macro correlation still exists in the data, which lead us to believe there will be some financial channel through Chinese private investors. This is the first set of results on macro correlation. But how do we further nail down this macro correlation to link it to the trading behavior of Chinese private investors? To do that, we use the macro level data from the QD mutual fund. In particular, we link the position change of the QD fund to the macro correlation. And we find that this position change amplifies the macro correlation found in our first set of results. And it is true both at the country level in 70 MSCI country stock returns, and also in individual stock returns in around 60 markets. Now, why is that? How come this position change of the QD fund can amplify the macro correlation we found here? Well, we hypothesize that it's gonna be the case, well, when you have easing Chinese monetary policy, those QD funds need to buy those foreign stocks, which in the end amplify the macro correlation. And indeed, that's what we find when we try to inspect this economic mechanism. Using detailed micro level data on mutual fund position changes, we find that easing Chinese monetary policy induces the Chinese QD funds to cut their holdings on safe assets, such as bank deposits, and increase their holdings on risky assets, especially on foreign stocks. It is because it can generate some price impact on those stocks. That's why the macro correlation we found before is positively correlated with their position changes. All these three sets of results suggest that Chinese private investors can indeed generate some price impact on the global stock markets. And in particular, this type of thing is true when we try to control for the economic linkages with China. So in other words, this financial channel we documented here is likely to reflect the price impact from Chinese private investors. This is the first set of results. We use Chinese monetary policy shock. The second set of results is to use another type of China-specific shock, which is the early onset of COVID-19 in China in January 2020. This is still working in progress. when COVID-19 first hit China, and those Chinese private investors would like to move their money out of China and then invest overseas. Therefore, we were able to construct a US stock level exposure to those QD mutual fund flows. And once we do that, indeed, we find US stocks more exposed to the Chinese QD fund flows. They rise more than those stocks who have less exposure to Chinese QD fund flows. In that sense, given that this COVID-19 shock is China specific, and these mutual fund flows is exogenous to those US stocks, that means Chinese private investors can indeed generate some price impact in a large financial market like in the United States. So those sets of results lead us to believe that even though the private flows from China is still not large, but they were able to generate some price impact in the global financial market. Now, in the interest of time, I'm going to skip the literature review. I'm going to highlight one thing, which is we focus on the private portfolio flows. It's around $0.6 trillion. Even though we use QD funds as for identification purposes, but in our mind, this QD fund is a representative of all Chinese private portfolio flows, which is small, still small in absolute terms, but are growing faster. To give you a sense, by some estimates, there will be 10% of GDP once China fully opens up. Now, obviously, our work is related to the growing literature, try to understand the Chinese connection with the rest of the world. Many of the audience actually contribute to the literature. So in this paper, we focus on Chinese private portfolio flow. Now, let me talk about the QD program, the data, empirical strategy, and also empirical results, and then I will conclude. Now, the QD program is one important channel for the Chinese private sector to invest overseas. As I told you, I myself, I actually use those mutual funds to invest overseas. It was launched in April 13, 2006. Initially, government tried to ease the RMB appreciation pressure and also pursue its long-term goal of liberalizing the outflow restriction. Now, this is the Chinese way of liberalizing its financial market. So there will be always quotas imposed in this scheme. In the case of a QD fund, a QD program, the quotas will be assigned to certain institutional investors, including banks, insurance companies, trusts, and mutual funds. And we're going to focus on mutual funds, as I said, by regulation, they need to disclose their stock holding information. Now, I also want to highlight that the QD program is different from other two important liberalization schemes that was better known in the literature. For example, the QFII program, Qualified Foreign Institutional Investors program, that is applied to foreign investors. You can see that as an inflows regime. It was initiated even earlier, at 2002. QFII is about outflow regime. It's not about inflows. It's about Chinese investors. It's also different from the Shanghai, Shenzhen's Hong Kong Stock Connect program that was to set up to connect the mainland and Hong Kong stock markets. It is a two-way liberalization, but only applies these two markets. Differently, QD allows you to invest beyond the Hong Kong market. Actually, some QD mutual fund take advantage of this Stock Connect program to diversify their portfolios overseas. Now, our data is from the Wind Terminal. That's going to be a Chinese version of Bloomberg. By regulation, QD funds need to disclose all their stock holding information biannually, and top 10 holdings on a quarterly basis. And in each of their quarterly report, you can also see their asset categories among different asset classes. For example, how much money is invested in stocks, how much money is invested in bond, how much money is invested in bank deposit. But you are only to see the detailed stockholding information biannually. We're going to focus on the period of 2007 to 2019 because later Chinese monetary policy shock only ends at 2019. But so far, we are extending this sample to study the COVID shock as well. We merge this funding information with standard data set like data stream and word scope. We use ISIN as identifier to merge these two pieces of information. The first key macro variable we focus on is identify the Chinese monetary policy shock to M2 growth rate, constructed by Kaiji and his co-authors. And that's a shock to an M2 growth rate. It's at the quarterly frequency, only ends at 2019. So that's why our QD funding information, we stop at 2019 as well. Now, how are we going to conduct our empirical strategy? Now, we want to estimate the price impact of Chinese private investors. That's represented by the dotted line from all Chinese equity investors to the rest of the world, Australian stock market, US stock market, and other countries' stock market. Of course, Chinese investors are separated mainly by the capital controls policy, that is the squared frame. And to identify this channel, we need a China-specific shock, either monetary policy or COVID, that induces these equity investors to do portfolio trading, and then we can trace their price impact afterwards. This is going to be the financial channel we are interested in. Of course, we are aware of there will be an economic channel, or the real channel, through which those shocks affect the real economy, and through the real economic channel, they can affect the rest of the world as well. So that part of the thing we're going to try to control by using the bilateral trade relationship with China. Now, our first empirical result is about the macro correlation between Chinese monetary policy shock and stock returns in other markets. Following Anusha's work, we're going to run the following specification using quarterly stock returns at MSCI country level from 2000 to 2019. Our key variables that we are interested in is identify Chinese monetary policy shock. Of course, we need to be carefully control for other global factors like US monetary policy shock, VIX indexes, and country level fundamentals and real linkages with China. So here is a macro correlation estimate. In the data, we find that there is a strong positive correlation between monetary policy and MSCI country stock returns. The number is around 0.016, positively significant. If we think about how plausible this number would be, or how large it implies for the flows from China, here is a back of envelope calculation. Of course, all this done is under the assumption this estimation purely nail down the financial flows from China to the rest of the world. Now, economically, one standard deviation of Chinese monetary policy shock, 1.34%, is associated with a rise in other countries' stock returns around 0.021%. Now, if we take the price elasticity of demand estimated by the literature, which is about 5, that implies the types of money, the magnitude of Chinese flow is around 43 basis points of the market capitalization. That implies you need $4 billion per quarter from China to the rest of the world. This number is reasonable, given that I told you that Chinese portfolio flows is around $0.6 trillion. This macro correlation is robust to controlling for other economic channels as well. For the interest of time, I'm going to skip this. Our second set of empirical results is to link the macro correlation with the portfolio changes of the Chinese QD fund. For that purposes, we're going to construct a QD fund exposure. That is a country portfolio exposed to the Chinese QD fund. To do that, what you can do is to add up total Chinese QD stock holdings in the country. And then you normalize this number by the country's stock market capitalization. And you can take a year-over-year change of that number. This number captures how exposed you are to Chinese QD funds. As I told you, this stock holding information is only available semi-annually. The stock return level information is quarterly, so we're gonna use the latest information to match with the quarterly stock return information. Now, the OLS regression tells you that indeed the macro correlation is strengthened with these changes in QD fund holdings. In other words, those QD fund portfolio indeed amplify the macro correlation. Now, this country level results also hold if we use a more granular level data, which is to use individual stock holding information. So we can rerun the regression, but at the individual stock level, here the RICT is stock I listed in country C at quarter T. Similarly, we can also construct the QD stock holding exposure to add up all the monies or the holdings from Chinese QD funds and normalize by these stocks market capitalization, calculate these changes, and then try to allow this correlation to link to this exposure. Now, reassuringly, at the individual stock level, we also find this macro correlation is related to the position change of this mutual fund of this Chinese QD fund. Now, why is that? What is the economic mechanism behind this result? Well, we hypothesized that an easing Chinese monetary policy induces these Chinese QD funds to reduce their holdings of safe assets and increase their holdings of risky assets. Now, to test this hypothesis, we can use the alternative asset classes for each individual mutual fund, and then we see the portfolio shares changes or their responses to Chinese monetary policy shock. Indeed, in the data, once we do the regression, following an easing Chinese monetary policy shock, these Chinese mutual funds cut their bank deposits, this is gonna be the safe asset, and they increase their risky asset, which is in stocks. And in particular, if you divide those stocks into foreign stocks, A-share stocks, and Chinese external listed stocks, you find that it is the foreign stocks who drive the results. Therefore, the picture is complete. Chinese monetary policy induces those mutual Chinese QD fund to rebalancing from safe assets to risky foreign assets, and therefore gonna beat up the stock returns of those stocks. That's why the macro correlation is amplified by their position changes. So that's the first side of a result using the Chinese monetary policy shock. Our ongoing work is to look at the COVID-19 shock. Here, the assumption is the early phase of COVID-19 in January 2020 is a China-specific shock. And we're gonna focus on the United States. And the thing we need is to construct a US stock level exposure to the Chinese QD fund flows. We're gonna use the information from the 2019 year-end stock holding information. This is before COVID. And the 2020 monthly DNA, that's total net asset value of the aggregate QD fund. Here, you only got the aggregate monthly series from the public sources. You don't have the individual monthly TNA for each fund. Now, how do we construct the fund flows at the individual level? Well, we're gonna allocate the aggregate flows according to individuals' TNA weights in the aggregate, using the information in 2019 Q4. Now, given the individual mutual fund flows, we were able to allocate these flows to each US stock according to their shareholdings in 2019 Q4. And once we get that, we can aggregate to all those dollar flows from Chinese mutual fund to each individual US stocks and normalize it by the stock market, by its stock market capitalization. This way, we construct a US stock level exposure to Chinese QD fund. This is similar to the flow implied fund allocation changes constructed by Christine and his co-authors, which we call FIFA exposure. Now, once we get this FIFA, we can form 5 portfolios of non-zero FIFA or positive FIFA. Why do we want to do that? Well, the reason being, QD fund select US stocks in a systematic way. In particular, almost all the SP 500 indexes were selected by the QD held stocks. If we will compare non-QD held stocks with QD held stocks, you end up comparing SP 500 versus non-SP 500 stocks, which will be subject to selection issue. For that purposes, we're going to focus on all those QD held stocks and form 5 portfolios based on their exposure to those FIFA variables. And then we can compare the cumulative abnormal return differences over a period of January and March in 2020. There's going to be a shock transmission from China to US. Now, the first set of results is at the portfolio level. Here, the Q5 is the highest FIFA stocks, including Apple, Microsoft, and other stocks. And Q1 is the lowest FIFA stock. As you can see, if you receive highest amount of money from Chinese mutual fund, your stock return is relatively higher. If you receive lowest flows from Chinese mutual fund, maybe outflows, your stock return is lower. The difference actually is statistically significant. We can look at this issue also at the individual QD held stock, run a regression between the cumulative abnormal returns on those fund flows, controlling for other stock level characteristics. The message is similar. The more money you receive from Chinese mutual fund, the higher return you will be, other things equal. Now, this preliminary analysis in the COVID period suggests that Chinese private investors can have a price impact even in US market. Now, I think I'm running out of time. Let me conclude. So what we do here is to show you China has a growing financial impact on world stock markets. This is consistent with the gradual process of outflow liberalization in China. And this effect exists in both individual and the market level. It's because of the portfolio rebalancing of the QD fund. Our work in progress is to utilize the FIFA variable I showed you before, not just apply to the COVID, but maybe construct a time series estimate for US market and other markets as well. Once we have that number, we will able to say more about the evolution of the price impact from 2007 up until now. So I think I will stop here and look forward to the Q&A. Thank you.
Thanks a lot. Thanks a lot, Chang. So floor is open for questions. Saleem.
Thanks, Chang. Very, very interesting paper, and I enjoyed hearing about it. I had 2 questions if I can. So first, you had the WCT variable, which was country level responses to, or country level changes in the QDI allocation. I was just wondering, how does that respond to the shock? Can we look at sort of like how different countries react to monetary policy shock using that variable, as opposed to look at the sort of average responses across different types of investment? The second was more like maybe a deeper question, which is, you know, if I went down some sort of asset pricing model, should Chinese monetary policy affect the discount factor in that model, the SDF? I guess it should. And I mean, are we then worried about some sort of idea that SDF prices the assets differently with a high W versus a low W in your model, and that sort of contaminates things. So it's not a flow story, it's a sort of compensation for risk story or whatever. Thanks.
Yes, thank you, Saleem. Very good question. So yes, for the delta change of the WC at the country level, we could run regression to see how it responds to the Chinese monetary policy. Yes, we haven't done that. We could put it on the to-do list. The second question, your question is about whether Chinese monetary policy will affect the discount factors, right? Discount rate across the global. We could try that, but I'm not sure whether Chinese monetary policy is powerful enough to actually change the risk aversion of global marginal investors, right? So based on Annie Rain's story, right? You know, the Chinese monetary policy affects the rest of the world mainly through the trade and the commodity markets, global value chain. Here we are not saying something different to her. We are actually complement to her story. What we are saying is the Chinese monetary policy affects Chinese investors. Okay, it's not the global marginal investor. Affect Chinese investor, they gonna do their portfolio rebalancing to the rest of the world. To the extent they could generate some price impact, that's something we find. I'm a little bit skeptical that Chinese monetary policy can affect the global banks' risk aversion. That would be too much. That's my gut feeling. But we can test that in the data.
So there's one question by Gong Chen. Hi, Gong. Thank you. To what extent does the MP shock capture the overall economic conjuncture in China? Thus, the stories about investor sentiments in economic downturns.
I see. So this gonna be, yes. So we haven't tested this story, which is the overall economic conjuncture in China settlement, settlement story in the economic downturn. We could construct some investor settlement level data and run a regression on that. But I'm a little bit skeptical on that will affect our result because the monetary policy shock was constructed in above of all those expectations. So to the extent the agent has put their expectation on economic conditions about future economic conditions, this shock itself should be identified in above of those expectations. So in that sense, this shock is more identified. But yes, we could check whether in the data, the sentiment measure of investors actually being affected by Chinese monetary policy shock. We could do it.
Aitor.
Yeah, thanks. Very nice. So I'm just thinking about this last regression you showed us, right? We're like, there is simultaneity, right? So I'm wondering the extent to which, these significant coefficients that you show, that what they show is the fact that the portfolio managers of these funds in China are very sharp. So they are expecting some stocks to perform, and they actually find the stocks that are going to perform. And that's, you find this correlation. So I don't know if this is an alternative story. And it's more than the flow is that they know where to place the savings of Chinese people. Right? So I don't know if this story can also go. Thanks.
I see. Yes. So we are actually working on that specification. So a stat aspect in the data is most of the Chinese mutual funds are indexes to some benchmark, in particular SP 500. You see that in data as well, and they hold almost all of the SP 500, and their shares on those stocks are, my guess is they are invariant. What we are trying to say is the flows, the money from Chinese household flow into those mutual funds, and those guys, when they receive this money, they're gonna allocate this extra money based on the shares they had before. Those gonna be the extra flows into the US market. And that will generate some price impact on the stocks those guys buy. To give you a number to see whether that's plausible, in our FIFA number, so the highest US stocks which receive the Chinese mutual fund is Apple. The dollar of money it received is around like $600 million in a month. So that will be very sizable to generate this price impact. And of course, some funds, they actually receive some outflows because not all funds, will receive positive flows. For example, like AMD, they receive mutual fund flows from Chinese funds. So that's why the AMD stocks actually drops more than Apple. So in that sense, I'm less concerned about this selection issue over there. It's purely the flows from Chinese investors to the US market.
Maybe one way to make a little bit more, I mean, like to give an additional sense of how important these investors are is to use some measure of these flows vis-a-vis turnover for those stocks, right? So we can get a better sense of how important this is actually for liquidity in trading. I mean, like you say 500 million, it sounds like a lot, but maybe then it turns out that it isn't that much, right? And the mechanism is elsewhere. The mechanism is elsewhere.
Yeah, that's a good point. Yes, we could do it. We could normalize these numbers by their turnovers and see how important this number would be for the few stocks. Yes, thank you.
Great. Further questions? All right.
The raised hand in the audience, Christoph. Jinglin Yao, if I see that correctly.
I'm not seeing that. Where can I see that? Yeah. Please come in.
Hi, thank you. Thanks for the amazing presentation. I actually have two questions, if I may. The first one is about your definition of shock. So you use the M2 growth rate, M2 to define, get the residual and define the shock. And my question is, we know that the People's Bank of China has made conscious effort to liberalize the interest rate and to make it more market oriented. So this means that we're transiting from quantity-based monetary policy to a price-based monetary policy. This is especially the case for the most recent period. So if you're using the M2 growth rate, are you interpreting the fact that the People's Bank of China has failed to liberalize the interest rate, to put it this way? So the second way, my second question is, if I look at your result, so the rebalancing of the investors' portfolio towards foreign equity when you try to establish the mechanism, and I saw that there's no rebalancing, basically no rebalancing towards the domestic equity, I mean, the domestic equity, Chinese domestic equity is not necessarily less risky than the US equity. So how would you interpret the fact that they're only rebalancing towards foreign equity investment? Thank you.
Okay, thank you. Yes, for your first question, yes, indeed, China is transforming from a quantity-based to an interest-based rules. For the record, we're not saying China is failing to do that. We actually, if you look at the regression, we start by 2019. You are exactly right. The quantity-based rules or quantity-based shock stopped to work after that. So that's why we end our exercise in that period of time. And this M2 growth rate shock is identified by previous paper. It is notoriously it's notoriously hard to really identify the Chinese monetary policy shock. It was well known in the literature. Unlikely in the United States, you have the scheduled FOMC meeting, but Chinese policymakers don't do that. That's why it's very hard to identify Chinese monetary policy shock. And that's why we rely on the previous literature, use this M2 growth rate shock. So we have some confidence on that. But of course, you can refine this by looking at the announcement type of shocks, but that desires more work on that. So your second question, the rebalancing from the safe assets to foreign stocks. I think the reason being, it's gonna be the reason the foreign stocks provide more diversification for Chinese households. So when easing Chinese monetary policy, inject more liquidity or reduces the risk aversion of domestic mutual funds, if they were to take more risk, they are going to channel their flows to the stocks that provide more diversification benefit, which is the foreign stocks. So that's why I'm not really surprised by that type of results.
Thank you.
Okay, we're perfectly in time. Thanks so much, Chang, for a wonderful presentation and for a lively discussion here, everybody. So now it's time to move on to our last presenter for today, Andreas Presbitero. Hi, nice to have you here. Who will present the HIPC initiative and China's emergence as a lender post-hoc or propter hoc. You will need to explain that. I have 5 years of Latin, but thanks.
Okay, thank you very much. So I hope you can hear me.
Yes.
And you see the slide. Let me just put it full screen, and then we can start. Okay. Perfect. So first of all, I think this joint work with Tito Cordella at Johns Hopkins, Maya Confredi, Torquato Vitella, and David Mihaly at Kiel and the World Bank with the IMF. So the usual disclaimer applies. These are our very preliminary views, and does not reflect the view of the World Bank, the IMF, and everyone associated with the institutions. So the other disclaimer is that differently from the great paper that I've listened to through the day, this is truly a work in progress, meaning we're going to present some results that really came out this week and some of them yesterday. So even ourselves, we didn't have so much time to digest them, but we think it's going to be interesting, and clearly this probably the best audience in which we sort of can try to show what we have and gather reactions, possibly not too negative, but let's see. So the paper is a paper about, we want to sort of, there's a lot of, the motivation is straightforward. There's a lot of discussion about sovereign debt restructuring and problems. So some people are arguing that it could be a time for a new HIPC initiative, so a coordinated effort to provide debt relief to developing countries. That could be shown in different ways. There's a standard chart that, probably many of you have seen so many times. It's the chart from the bank and the IMF showing the share of countries in the distress. This is basically the sample that we are using, which is basically low-income country DSSIs. And you can see, like, over time, let's say we didn't go back to sort of post-HIPCs, but in the last 10 to 15 years, like the number of countries which are at high risk of the distress or in that distress has been growing quite a lot. On the other hand, one could also argue that maybe we could create, with sort of providing relief and structure, we could create conditions for a new wave of debt restructuring. Here is sort of a chart that look again at a larger sample of countries, and it plots on the solid dark line the share of countries which are experiencing debt surges, which is sort of basically defined looking at debt over GDP series, filtering the series, and looking sort of episode in which debt was growing in a sustained way. And then with just basically plotting on the bars the number of debt restructuring episodes year by year, like separating out restructuring with private creditors, with the Paris Club, and with China, using some of the data that Sebastian and Christoph put together. What is interesting here is that what you can see is basically in coincidence, more or less, after the sort of multilateral debt relief initiatives in the late 90s and early 2000s, clearly debt levels in developing countries went down, so that the share of countries with sort of growing debt went down. But then after that, like in the aftermath of that, clearly we don't see any restructuring, but then all of a sudden we start seeing this large increase in the number of countries which are increasing and building up sovereign debt, that toward the end of the sample, we see a new sort of a larger number of countries experiencing debt restructuring, especially like there is a lot of discussion where now about countries which are close or on the brink or already in that distress. Clearly, the two bars for 2020 to 2021 are inflated by the DSSI, which is some sort of a very specific debt restructuring. It's not as a standard one. But, I guess the idea is that, if you look at the time series, you see debt relief, that goes down, and then you see that build up and possibly restructuring going forward. So the question motivated by that, there is one big question, and which is basically, what does that restructuring imply for a developing country? And this is a large question that can span many strands of literature. Within this large question, we want to pin down one specific issue. And so we want to focus on basically net flows, meaning disbursement minus principal repayment. And we want to see what happens to net flows to countries which receive that restructuring in the aftermath of that relief, okay? And we want to see if that relief changes the volume of net inflows to those countries, and maybe changes the composition of net inflows, meaning if there is a change in the type of creditor which start lending to those countries. So the idea is that that relief, to some extent, can sort of create incentive for some creditors to free ride and jump in, exploiting the fact that some other type of creditors provided up to debt relief. So you have debt relief for multilaterals that create fiscal space, some other creditors jumps in and start lending to the country which now has the capacity to borrow. And clearly this is important because these new creditors can clearly increase their exposure and lending volume to those countries, but with that, they can also increase their political influence on those countries. So if we start with what we think is the current wisdom, at least, I guess it's a fair characterization of what people think. The idea is that the HIPC initiative, and when we say HIPC, we can put together HIPC and MDRI, so this effort for multilateral debt relief that came from the World Bank and the IMF and the Paris Club in the mid-90s, created the condition for the emergence of China as a new major development lender. Clearly, it's not only China, there are other emerging lenders, there is a lot of private sector lending and bondholders, but I guess the common wisdom and the popular story is that after that relief, then there are conditions for somebody new to start lending to those countries. And you can find many citations like in the press, even in research. And here we put something from The Economist in 2007, showing that basically pointing to China's free riding and make the point that, for instance, some African government can afford fresh loan from China only because the multilaterals, and meaning the African Development Bank, the Fund, and the World Bank, recently forgave their ones. So that's one way of characterizing what has been happening. So I think there could be different reasons why sort of the West, or traditional donors, does not want to consider debt relief initiative unless new lenders, and for new lenders is again mostly China, also participate in good faith. And this is clearly connects and ties up to all the discussion about the G20 common framework, which sort of replaced the Paris Club as the main forum for debt relief, which is sort of, this is the idea of sort of reflect the concern that you want sort of the different creditors to sort of approach debt relief at similar ground. And this still, what we argue is that this is not only a problem of geopolitics and having a new lender with sort of different geopolitical interests from the traditional Western donors. So we don't want to make the point, we don't want to make the point of just comparing and contrasting Western donors with new emerging donors as a situation in which the two kind of lenders have different geopolitical interests. This matters for a number of economic and efficiency considerations. So here we just point to a couple of, to three charts that make the point that these new lenders clearly are different from others, from a number of characteristics, economic characteristics. So, for instance, if you look at Chinese lending, here we did some very simple exercise in which we look at the cyclicality of Chinese lending compared to the cyclicality of bondholders, multilateral and Paris Club lending, and you can see that Chinese lending is to some extent pro-cyclical, while generally traditional Western donors, multilateral and Paris Club, tend to be anti-cyclical when they lend to those countries. So that's one first area of concern, so different lending behavior between China and other lenders. The chart in the middle is actually taken from the work that one of the co-authors, David, has with Christoph on the African debt database, and the chart here makes the point that Chinese lending is clearly more expensive and carries higher interest rate than similar loans provided by official lenders. And the one chart on the right looks at another dimension, which is seniority. And also here the chart is again inspired by some of the work that Christoph has done in the past, when it was looking at the seniority of different potential lenders, looking basically at the ratio of arrears to the stock of debt. And here we basically replicate that chart and we add to the chart the role of China. And as you can see, over time, China started at the beginning of the period in the early 2000s, behaving very similar to other bilateral lenders and Paris Club, and all of over time it moves much closer to multilateral senior lenders like the IMF and the World Bank. So it seems, at least if you look at data on arrears, with all the caveats some of this data have on the IDS, it seems that China seems to behave much more as a more senior creditor than it used to be at the beginning of the period. So this is sort of a big digression to motivate our research question. Let's say it's much narrower. And so we want to sort of understand if the HIPC MDRI and MDRI sort of was plugged by new creditors taking advantage of debt relief from traditional creditors. And, when we start to approach the problem, the research project, our priors were that after HIPC, sort of Paris Club and multilateral would have reduced their sort of assistance, meaning net flows to such countries. And, you can think of donor fatigue and many other reasons why that could have happened. And because, as I said, because of new debt space, new borrowing capacity, China, together with others, especially including the private sector, could have become sort of particularly interested in lending to those countries. So we should have seen sort of a substitution out from traditional to emerging donors in lending and in net flows to HIPCs. And so that if this is the case, then debt relief initiatives should sort of should be aware of cost of the dilution and the free rider problem in debt reduction. Again, here we can connect with a very extensive and sort of old literature on that. So if you look at the aggregate evidence, I think that's probably the aggregate evidence is why we had those priors. So here we just plotting some chart that I guess many people in the audience have seen many times. On the left-hand side, you have the public and public guarantee external debt of a share of GDP in the SSI countries. And clearly at the beginning of the sample, here it started in 1995, you have the sharp reduction in debt levels. That's basically debt relief. And then, because of the scale, you don't see that much, but here's sort of a recent sort of not negligible pickup in debt levels, across median, interquartile range, and so on and so forth. Clearly driven by many things, there is most recent period is COVID and other situation, but even before that, there was this recent pickup in external debt. What is interesting and what people is attracting the attention of, a lot of research and a lot of policy institutions is that this pickup in debt is come with a sort of a change in creditor landscape. And on the right-hand side, we basically plot the share in public external debt of China, sovereign bonds, and private creditors. And you can see there is, again, starting in the late 2000s, an increase in the share of these emerging donors, private sector in China, and most notably China. So in the aggregate, that seems to support our priors. That said, and that comes with the Latin that Christoph mentioned at the very beginning, the fact that one thing's come after the other, it doesn't mean that, that's causes like what you observe. So we need to do something more. And so we started looking at the data as they are. So we started looking in more details. And as I said, net flows of China to the SSI countries, splitting the sample in HIPC countries and non-HIPC countries. So we only look at the SSI eligible countries. This is basically a sample of low-income countries, plus a couple of others. Then we split, and they're more or less split equally between HIPC countries and non-HIPC countries. So to some extent, we are comparing countries which are very similar because they are very, at least in terms of GDP level, they're, equally poor. Clearly, they are different in terms of initial level of debt in the 90s, because some were eligible for HIPCs because were heavily indebted and some other no. But if you focus on a more recent period, we are looking at countries which are somewhat similar. And as you can see, if you look at net flows, the share of GDP, here we're looking at the mean across the two samples. China, net flows to those countries are very, very similar. Actually, this chart came up as a surprise to us because it's some sort of a very nice parallel trend if you want to do some examples later on. They really behave similarly. So that seems to suggest that maybe the aggregate evidence that we're showing is slightly hides something slightly different. And so because of that, what we do is that we look at net inflows to HIPCs before and after debt relief, and basically we take the decision point, which is the first step under the HIPC as a sort of our treatment date, and then we compare net flows to HIPC and non-HIPC and then we look at net flows from different countries, from different potential creditors. Clearly, we just can't do the comparison that I've shown to you because, even though these countries are somewhat similar, there's a lot of differences. So the way we try to sort of get some sort of identification and meaningful comparison, and we do use synthetic control method. And so we take the non-HIPC DSSI eligible countries as a sort of donor pool to try to construct for each HIPC basically a synthetic control. And then we look at net inflows over GDP coming from all creditors. And then we zoom in at specific creditors. And so we look at multilaterals, the Paris Club, China, other emerging donors, which are not Paris Club, bondholders, and the private creditors. So we basically break up the inflows from all creditors across creditor groups, taking advantage of the fact that the international debt statistic from the World Bank recently come up with a very detailed information at the creditor level. So as I said, we look at the sample of DSSI countries. We have data on net and gross flows by creditors from the World Bank IDS. We use the latest vintage from last year. And then we have, to look at IMF lending, we actually rely on IMF data on IMF lending to those countries. And then we have a bunch of other variables which we use to do the match to do our synthetic control. So we have real per capita GDP, we have growth, external debt, current account deficit, all from the World Development Indicators, and some variables from the IMF World Economic Outlook. So it's basically straightforward and very sort of off-the-shelf basic data here. So if you look at the stellar facts, these are again the same chart I've shown before. Before I just show you sort of the lending of China to different countries. Here, we zoom in on our sample, which is the DSSIs. And so again, the red line is the mean lending. So the lending to the mean HIPC, the average HIPC, and the dashed blue line is the average lending to the non-HIPC countries. And so the left-hand side panel is China. And again, it seems that if we restrict the sample to DSSI, if anything, China is lending much more. So the sharp acceleration of Chinese lending in the 2000s seems to be skewed much more toward non-HIPCs than HIPCs. If you look at private creditors and bondholders, there is a sort of a somewhat similar increase in the recent period of sort of private sector lending to both HIPCs and non-HIPCs. And again, it doesn't seem that HIPCs comes up with sort of a much worse in terms of, much higher capacity to borrow from private sector. Then if you look at multilateral and Paris Club, also we don't see sharp differences here without doing any adjustment to the data. So there is a decline in multilateral lending, which is somewhat common, and then there is a pickup, and the Paris Club, so there's a strong decline, and then the Paris Club more or less keep providing net flows, which are somewhat similar between the two groups of countries. So this is just the data as they are, just to provide some descriptive statistics. So the empirical strategy, very briefly, again, we're not doing anything particularly complicated. As I said, we use synthetic control, and we basically can work with 30 out of 36 HIPC countries because of data availability on net flows. We need the complete time series to do the synthetic control, and we match on characteristics 10 years before the treatment date, which is the year before the decision point. So our treatment date is the year before the decision point. And we smooth the series, taking 3-year averages, because clearly net flows to those countries are highly volatile. So we try to smooth them, taking 3-year averages. And so we do in some of the first set of results that I show you, we match on pre-treatment net flows. And then we'll do additional matching on current account over GDP, external debt over GDP, GDP per capita, and real GDP growth rate. And then I also show you results in which we simply match on the pre-net flows. In this case, we also have a larger donor pool, and you will see results are rather similar. We make sure, clearly I don't have the time and the space here to show country by country sort of synthetic control one by one. But the pre-treatment fit are generally good, apart from a couple of countries which are behaving like outlier and are excluded from the sample, and that's one of the reasons why we end up with 36. And then we look at post-decision point characteristics, meaning net flows and net flows of different creditors for the 22 years before decision point. Okay, and the way we do that is that we construct the synthetic control using net flows over GDP. That's our series. Then we construct for each country the weights to build their synthetic control. We keep those weights as given. And so for each country, we have the sort of the synthetic control, which will be the same throughout our analysis, but then we look at different series on the other, looking forward, meaning not only net flows over GDP, but net flows from China, net flows from multilateral, net flow from Pariclub, and so on and so forth. And we're going to look, and what's going to show you, I'm going to show you the cumulative net flows over time, also because in this case, there is a lot of the volatility of these flows. Think about like private sector lending, they have like one Eurobond 1 year and then nothing happens for 3 years. So we show the cumulative to try to have sort of charts which looks a little bit more meaningful and don't go up and down. So this is basically what we get looking only at net, gross and net flows. So here it's the only slide in which I'm going to show you the gross flows together with net flows, simply to make the case of why we think it's important to look at net flows. So the right-hand side, let's start with the right-hand side, which is net flows. This is basically here what we are plotting is a vertical sort of dashed line. It's the treatment date, which is the year before decision point. You have 10 years before that. And then after that, we're going to plot the average, the median, the interquantile range of the 30 countries for which we have. So we plot the gap. So the difference between the synthetic and the actual in the cumulative net inflows. So you can see it's basically that there is some sort of a pickup in net inflows in the first, let's say, 10 years or so, then net inflows goes down. But, if you look at the interquartile range, you don't have a clear sense that, there is any sharp acceleration in net inflows. There is not even a sharp acceleration. It seems to be broad, slightly positive, but, with a lot of, if I had to plot all the 30 countries, you would see there is a lot of variation. The countries behave very, very differently. If you look at gross flows, instead you see that gross flows tends to be down, especially like if you allow, like if you look after 10 years, gross flows goes down. So if you were to look at sort of disbursement, you would be tempted to say to infer that after HIPC there is a reduction in disbursement to those kind of countries compared to similar non-HIPC countries. So going back to net flows here, the interesting part is like looking at specific creditors. So we start looking at China, and then we pull China and other non-Pariclub bilateral creditors. And what you can see here is, again, we do a good exercise in the matching in the pre-treatment period. You see there are, the 10-year, basically there are no differences between the actual and synthetic control, but then sort of Chinese lending to those countries is lower than Chinese net inflows to similar non-HIPC DSSI eligible countries. It's basically contrary to our prior. Our prior were to think about Chinese lending going up, and this is actually not happening. And if we augment China with other bilateral, the evidence is even stronger. Okay, if you accumulate those flows, you see that even the interquantile range is sufficiently like below the zero. So there is a reduction in relative terms in flows to HIPC compared to non-HIPC. If we look at separately on these other bilaterals, again, it is negative. If you look at the private sector, there is slightly any difference. So it doesn't seem that, this sort of borrowing space create any sort of behavior in lending from the private sector to HIPC and non-HIPC countries. Finally, the last part is looking what happens to the Western traditional donors. If you look at the Pariclub on the right-hand side, it seems that the Pariclub doesn't change the way it was providing net inflows to HIPC and non-HIPCs. What really changes is the multilaterals. And multilaterals here, we have everything, but it's mostly like the World Bank, African Development Bank, and then IDB and Asian Development Bank. And you can see that from the very beginning, there is a sharp acceleration in net inflows to HIPCs compared to non-HIPCs. So if anything, it's exactly the opposite of what we were thinking. So there is a decline in Chinese net inflow, there is an increase in multilateral net inflow to those countries. Then we do, as I said, we do robustness, we exclude the macro controls, we can construct our synthetic control using a larger pool of countries. And I can go quickly over here, but the trend is exactly the same. Net inflows seems to go up. China, in this case, even stronger, the sort of reduction in net inflows of China to those countries, to HIPC countries. Nothing really happens for the private sector on the right-hand side here. And again, there is this sharp and visible acceleration in multilateral lending to HIPC countries. So in short here, what we have is that the response of net inflows to HIPC debt relief has been clearly heterogeneous, with net flows showing some moderate pickup with a lot of variation across countries. What is interesting is that the main driver of this upward trend is driven by multilateral lenders. In this case, the vast majority of HIPC countries experienced a sharp acceleration in net inflows from multilateral, while a large chunk of countries experienced a sharp reduction to net inflows from China and other emerging donors, contrary to the common rhetoric in which China would have exploited HIPC relief to provide a lot of lending to HIPC countries. So this is basically what we have. Clearly, there is a lot that we have to do here, and we're looking forward to your comments. As I said, the analysis is extremely preliminary, so we've done some of the robustness. There's much more we need to do. Clearly, one way would be to sort of go moving from synthetic control from some sort of synthetic diff and diff to try to sort of get some sort of confidence interval and sort of do some inference. And then now we basically use HIPC to sort of having some plausible exogenous variation and do some comparison. But the interesting part would be, can we sort of generalize that and extend the question to sort of more general question about what's happening after restructuring? And so we should look at other episodes and see what has been happening with if there is a change in the composition of lenders after restructuring, which is not only HIPC, it could be any other kind of restructuring. So, and then I guess hopefully there will be many more others of research. And let me stop here.
Great, thank you so much, Andrea. Very, very interesting first results. We already have one question by Andreas Fuchs. Andreas.
Hi, hi, Andrea. Very good to see you. And yeah, you wouldn't have needed the disclaimer that much of this has been created over the last couple of days. So very impressive work. So first is on the surprising result, so that you have the opposite finding for China and the synthetic control. Do you have any idea what might be driving this, if you believe that the synthetic control is causal? Second is, so even if we believe the results and you say, okay, there are a couple of robustness checks coming, so what can we learn from this previous HIPC initiative for a possible next debt relief initiative? So the way China provides lending has changed a lot with, for example, the Belt and Road Initiative. Chinese lending has become much more strategic. So there have been no country strategies prior to 2013, 2014. So how, even if it's really great because you challenge the conventional wisdom, and I find it convincing, but what can we learn for the future? And maybe a related question on the political implication. So even if we observe that Chinese lending has not been affected, or even we find the opposite result, what does it mean in geopolitical terms? So fine, Chinese lending is not going more to HIPC countries, but still what might matter from a geopolitical perspective, the relative size of the debt. So compared to Western countries, the Chinese influence is much more if the possible control over the economy. So the countries might, in relative terms, become more dependent on China.
Did I reply?
Sure.
Yeah, sure. First of all, thanks. Good to see you. And I invite also David, I guess, and Tito are here. So if we want to jump in case I missed something. So I guess the key question is if you believe the results or not. That's still I wouldn't commit 100%, but at least what we've seen is that it seems to be there, meaning for instance, I was a little bit worried that, expanding the set of donor pools could have somewhat killed the results or attenuated them. And this is not the case. And, the last slide I haven't shown in the annex is basically the weights that we have for each of the countries to build the donor pool. And, I know it's not a sort of a formal test, but they are somewhat very broadly spread. So it's not that we are constructing all our city control using very peculiar countries. Like it's not only Angola, or it's not only some very sort of countries which is a lot of Chinese lending, for instance, or very peculiar. So basically they are somewhat widespread, and especially when we don't condition on other covariates, we can expand the set. And so there is literally, like, I would say each donor pool, now I don't remember exactly the numbers, but it may at most probably could wait for like 20-30% of the potential, all the other countries in which they come in as a weight. So I guess visually, quote unquote, it seems okay. But then I agree that it's a lot has to be done, and possibly trying to drop selected countries just to be sure that you are not picking up something weird, exactly because there are clearly outliers that are not really outliers, meaning it's not that you don't want to throw out all the information that there is in the countries like Angola. At the same time, I don't think you want to have your strategy to rely only on those countries. So I think you need to strike a balance between the two. On the question about like what can we learn, yeah, I think the way we started was mostly like motivated by this rhetoric. Now there is a lot, meaning probably influenced by the place where I work, and it's a lot of discussion about that restructuring, and the try to go back at HIPC and think what we have learned from that. And I guess so and really I think an aspect that there is a lot of analysis on that restructuring HIPC, trying to see does this promote economic growth and investment and real outcomes. I guess there is not that much in terms of like how that affect sort of financing and net inflows coming in. So first of all, I think we want to make the point that it's important to look at how sort of net inflows have been affected by that. So if countries are actually losing or not, and then what is important is sort of the composition. So I guess for now, we basically can say something about sort of what HIPC implied. And I guess the point, assuming that the results will hold, is simply sort of contrasting this common wisdom that, HIPC created fiscal space for China to thread on the other. So maybe this results that seems to suggest that it's not the case. More generally, looking forward, I would like to make this not of an HIPC necessarily paper, but as I said at the conclusion, like generalize out of that and looking, after that restructuring, what happens in terms of financial inflows and changing either composition, and because clearly it's not simply because China or whatever. The chart we showed at the beginning that in this case, for instance, China is different from the other, not necessarily because it's China, but because these loans come with different conditions. No, they are like more expensive and so on and so forth. And so it could be that for other countries you also have a change in the composition, and that has economic effect, not necessarily going into geopolitics. Then the geopolitics finally is the third element, and I think here make things even more complicated, because I guess I don't know exactly how to sort of tie the two stories here. We are not saying anything about like what drives China lending here, if geopolitics or not. We're simply saying if they're taking advantage of this borrowing space. I've been thinking a little bit of that. I wonder if we need to find a way to sort of include sort of the geopolitical element in the analysis, try to sort of control for that. But then I need to do more thinking on that.
Yeah, I'll raise my hand myself. So yeah, this is important work, because I would have expected, like, I fully agree that there's this common view that China tapped into the HIPC relief, right? Basically free riding on Western debt forgiveness, and what you show is very contrary to that view, and that's important because it has been something floating around for a few years now. I'm wondering, this focus on HIPC versus DSSI. I mean, I understand the rationale of looking at HIPC from an IMF or World Bank perspective, but I'm wondering, whether you could broaden it up a little more and see, where the HIPCs of of 20 years ago and are not the potential HIPCs of the future or the current ones, right? So can you cut it more in terms of vulnerable countries? I'm also thinking about commodity rich and commodity poor countries. We know that China has focused heavily on commodity rich countries or countries that, you know, offer other advantages to China itself. So I wonder whether you could cut it there and, you know, close the narrative a bit more, saying, well, China didn't tap into HIPC, instead it did this, right? So this goes a bit into this creative composition direction you're mentioning. And that's the first point. So where did China go instead? You know, and are those not, because they predominantly went into poorer countries, right? Compared to, say, the average sovereign bond investor, for sure. Yeah, now I forgot my second point. I might get back to that.
No, I think that's a great point. I think the way I interpret this is somewhat related to maybe what Andreas was saying at the end. And I agree that it's a way of closing the story. So basically, one way of reading our result is that, you know, if you flip the question and make the question a question about China and ask, so what has driven like Chinese lending, at least at the beginning when China accelerated lending to developing countries. And I guess so far I would say not sort of this HIPC or new fiscal space, because it seems to go similarly to one and the other. And then I guess your suggestion would be, okay, you basically say no to something, okay, but there should be something else. And then I agree that one could sort of try to see and flip the question and see, so where China has gone, and again, it could be commodities versus no commodities, could be more geopolitics, and I agree, like, you know, Belt and Road is clearly sort of somewhat of a structural change that happened. And then looking forward, then it's on one hand, it could be a problem in the sense that if you believe that now there's a lot of other consideration, then maybe it's obvious that, you know, this fiscal space will not be important later on. But again, you can probably still build an argument that you have to provide that relief nowadays to those countries that still be possible to lend. And maybe it's not China, maybe it's more the private sector, because, you know, there is more financial development. So people could argue that, you know, there is much more private creditors coming in. So I guess that's still a way of thinking. I guess it's more like now you have a way of thinking of, you know, another aspect people should look at when thinking about potential implication after that restructuring.
Thanks. Laura, please first.
Hi. Thanks for organizing. So going back to this heterogeneity, I think this is what a lot of people have suggested. In Latin America, it's interesting because you see, for example, the countries that have been out of access, and that would be Argentina, is one that gets China. But you also see Brazil that has access, private access, also gets a borrowing from China, but it's a different type of borrowing. It does look more like private. And so perhaps that would allow you to get into whether they're going after HIPCs or more general after countries that have issues borrowing from the international market, and whether they're segmenting the market, which is also what I think is going on. When they have to play with others, they behave like others, meaning private. And when the market is there for themselves, then they do a different. And you see that is Ecuador, that is Argentina, that is Venezuela. It's very different how they have engaged with Costa Rica before we lost access, with Brazil. And I think Latin America will give you enough of a laboratory to try to go a little bit deeper in some lending that we know is not very transparent, as Christoph and Sebastian have documented.
Yeah, no, that's also like a good suggestion. I think, you know, to extend the analysis, it's something we would definitely want. I guess it's more like in the direction of making the story a little bit more general and not making a HIPC story. So it's something that we should do and look at. I think, yeah, it's somewhat related. We had some thought, and probably the paper at the beginning, when Sebastian approached us, we had an idea to writing sort of a paper which was more into this direction about sort of competition of China and the fact that in different countries China can compete or not, or be the dominant lender or not. So I guess that's some area where I think it would be clearly important to reflect and study. So yeah, thanks for the suggestion. I agree that looking at Latin America could provide a novel and interesting angle.
Sorry, Sebastian.
Hi, Andrea. Very interesting presentations. I shared your prior, so interesting to see this being looked at rigorously and tested rigorously. One suggestion would also be to look at the interest rates that China and other creditors charge in the immediate aftermath of the HIPC initiative, because it seems to me that the whole free riding argument somehow implies, right, that the interest rates charged by China were at the time not justified by the low level of debt after debt relief. So it could be interesting to see whether the interest rates charged by other creditors were more responsive to the falling debt levels than the ones charged by China and other non-Paris Club bilateral creditors.
Yes, that's another good suggestion. I think what we started doing actually yesterday, looking at these gross flows, and then we have the composition of gross flow by creditors, somewhat point in that direction, because clearly if you can see the difference in gross versus net coming from different creditors, the different behavior is explained in part by interest repayment. So it's sort of an indirect way of getting at what you are saying, but I guess some of the results seems to go in the line of what you said, but again, they were very preliminary and we didn't have the time to think. I didn't have the time to think too much on that, but it's the direction we are considering, and probably like looking at interest rate directly, it's the easiest way.
So I have another question, and that, or a comment rather. So it's quite fascinating to see these other multilaterals pushing at least HIPC debt surge. And I think that would be, I mean, the logical next step is to also look at MDRI, right? The official, the IMF and World Bank debt relief initiative. Because maybe it's, maybe it's a problem made by the very institutions, and China was just a useful culprit, where in effect it's your institutions and the World Bank who have caused this debt surge in the HIPC countries. So looking deeper into that would be, of course, a bit problematic, I guess, for you guys, but fascinating. So understanding also the motives behind that, right? I mean, why did so much money flow to from the richer from the multilaterals there? We have this Africa debt database that you mentioned, and there you also see that besides China, it's really the multilaterals, especially in the recent years, that have poured in money, which again might be geopolitics, right? So dissecting that more would be fascinating, I think. Yeah. So kind of the multilateral debt surge. I haven't seen a paper kind of
exactly. I agree.
tracking that, right?
Yeah, I agree. And it's something doable. Yeah, it's something definitely doable, and I think it has to do with the latest point you said, the potential competition, right, and coordination, competition in some countries between emerging and multilaterals. So that could be one way one could try to rationalize that. I guess there are some papers about sort of competition and coordination or complementarities between World Bank and China lending in Africa. So I guess that could be part of the story. Yeah, but
Great. We have one last question here by Yuan Shen online.
There's also Silvia.
Oh, why I'm not seeing the? I see. I'm not seeing. Oh yeah. So let's. Silvia, please come in, if that's possible.
Hello. Hi. Can you hear me?
Yes. Hi, Silvia. Yes.
Okay. Hi, Andrea. Nice to see you. A nice paper. Actually, I have a question about the old issue about the defensive lending. So if you can check the creditors are responsive to when their own debt share is higher. For example, in the case of China, I don't know if it lends more to countries that have high talk of that it is owned to China or similarly for other groups. Thank you.
Yes, no, we'll check that. I think it's a good suggestion, and doing that it brings back to memory stuff that I've read like 10 years ago, and including defensive lending. So yes, that's something we should check. It's a very good suggestion. Yeah.
Thank you.
All right, so let me get back to if there's not any more, no more comments. Okay, well then, let me take this last question, Yunan Chen. It strikes me that this reflects conservatism of part of the Chinese creditors and a lower risk appetite for countries that have gone through a debt restructuring, which could make sense. I'm curious on the results regarding private sector creditors, however. You say they appear indifferent. What explains this apparent lack of change for private sector creditors?
Yeah, it's I don't have an answer now. We didn't focus too much on that. We wanted and start looking at the China and other non-party club. I think the way to go here, which probably answers some of the questions that came out and also some of Christoph's point, could be like everything that I've shown is basically this average interquantile range, but for some of those countries, especially for the one which are somewhat on average flat, like the private creditors, there's a lot of variation. So an interesting part would see to try, can we explain for why private creditors went in some of the HIPCs and not in some other of the HIPCs, and that to some extent that could also be to China, and that could ties to like the commodities or geopolitics. So I guess we can still use the result that we have rather than just showing the average results or the median, trying to exploit the heterogeneity because there is a lot of this heterogeneity, and try to see like where within that sample, private creditors tend to focus more than others. But then I don't have an answer for that yet.
All right, with that, I would probably call it a day. Thanks a lot, Andrea, for your presentation and the discussion to everybody. Tomorrow, we will again start at 2 p.m. Central European time and all the other times. And we'll have papers by Laura, Aitor, Andreas, and Sebastian. So very much looking forward to that. Today was great fun. Really enjoyed this. Thanks a lot. And yeah, have a nice evening, afternoon, day, whatever, wherever you are. Great. Thanks a lot, guys. Bye.
Thank you.
Thank you very much for organizing. Bye-bye.
Bye.